Nageswara Garu, good morning. Can you hear me?
Good morning, sir. Yes, it is audible.
Yeah, I'm audible, sir. Yeah. How are you doing, sir? How are you doing?
Fine, sir.
Good, good. That's good. How many are there participants?
18.
18. Okay, good. We'll wait for 5 minutes. People are joining slowly. So Nageswara sir, what do you suggest?
Good morning, sir.
Very good morning. You want me to wait for a few minutes?
So we can start, sir.
We can start. I think there are just around 6-7 participants. I think total 18. That's what I heard. I want to wait for 2 minutes. I'll wait, or else I'll start off.
Okay, sir.
There are only 6 participants, I think.
Okay, sir. We can wait for 2 minutes then.
All right. All right. I think the number remains the same. People are not joining.
I think you can start, I think.
Okay, fine. We'll do that. I think a couple of more join now. So good morning, friends. Good morning to all of you. Welcome to today's presentation. Welcome to today's presentation. On the first session, I'll be covering securitization, followed by project funding, capital sources. Project funding will be discussing. That's our today's agenda. Request you all to, for a few minutes, put your video on and then you can put it off. I'm Venugopal, a part of NMMS team. I come with almost 40 years of experience in banking, finance services, and insurance. That includes operational banking, investment banking, insurance, and capital markets. That's about me briefly. So very nice to be connected with all of you. We're all senior management team, accomplished people handling the important projects related to railways. I think some of you I've met in earlier sessions, I think. Padmati ma'am, I think you were there. Balaji also.
Yes, sir.
Yeah. So nice to get reconnected. Mr. Srinivas also, I think. You were there in one of my earlier sessions. Right. Okay. So you can switch off the videos now. Again, we will be focusing on the PPT. So just to have an introduction, I wanted to have the PPT videos on for a few minutes, right? So thank you very much for putting the videos on. Now will be first topic of today is securitization. So let's have a look. What is this securitization all about? How many of you have, let me first understand, how many of you have experience in financing the projects or participating in the finance of transactions related to your railways? All of you are railway only, right?
Yeah.
Yeah.
No.
How many of you have experience in, in participating in financial transactions, raising capital, working capital?
Not directly, but we were somewhere we are been associated. Yes.
Okay, good. Right. First of all, please confirm if you are able to see the PPT. All of you, please confirm.
Yes. Yes.
Yeah,
it's okay.
Yes, we have seen the PPT.
So what is securitization? It's a issuance of marketable securities backed by the expected cash flows from specific assets. So you are a company, you have certain assets in your balance sheet, which generate certain cash flows. They can be some loan related transactions. You have given a personal loan, car loan, or some receivables. You have to receive electricity bills for electricity department, electricity bills, railways, airways, all those corporate clients have to pay some amount. You have certain receivables in your balance sheet, right? And they have some specific time frame for receiving the cash flows. They are spread over certain period, 1 year, 3 years, 5 years. If it is home loan type of thing, then it could be something like 10 years, 15 years, 20 years also. So your receivables are frequent and spread over certain period. You want to convert it into cash immediately. You want to improve your operating efficiency. You want to utilize your funds better, rotate the funds faster so that you increase your turnover and return on your equity or return on capital employed. You want to improve. So whatever is there in your balance sheet, the assets whose cash flows are spread over certain period, this you want to convert into cash immediately. This is possible through a process called securitization, right? So issuance of marketable securities. That means a security, the meaning of security is it's a financial instrument which is tradable in the market. So there is an issuer and there's an investor. An investor has a claim on the issuer, and that instrument is tradable in the market. That's called security from the finance language. Marketable securities, which are tradable in the market. So they are underlying asset is certain cash flows related to a particular asset. This is securitization. So what is being done here is all these assets are pooled, and contractual debt and selling the related cash flows to a third party investors as securities. So I pool the assets, I issue securities to the investors. Investors put money so that I get money immediately. So investors, so my receivables are now transferred to the investors. So I collect money from my underlying assets and pay to the investors. But do I do it directly? No. I'm involving some other parties also. Okay, let's see. This is Indian securitization market is something like 2 lakh crores in 2020. It was just something like 25,000 crores a decade ago, less than a decade ago, 5 to 7 years ago. It was something like 25,000. Now it is 2 lakh crores. So you can see the growth in securitization market in India. Globally, the size is 11 trillion. And out of which 7 trillion are mortgage-backed securities. Means the underlying asset is real estate, which is being funded and which has a regular cash flow. So Indian market size, global market size. Indian market size is still very small if you compare to the global market, but it is still evolving in Indian markets. So which type of assets you can securitize? So any asset, a receivable, which has a predictable stream of cash flows, means there is some regular periodicity attached to it. There's a regular period interval at which you receive the cash flows, right? and they're predictable. Okay, every month, every quarter, every year, like that, you get certain regular cash flows. So those type of assets can be securitized. So why you do it? So you improve your balance sheet position and you improve your turnover. You are converting them into cash and rotating the funds faster. You are increasing your business. And you are also in the process transferring the risk to the investors, better risk management. Whatever risk is associated with those receivables are now being transferred to the investors, better risk management, improved balance sheet structure, improved turnover, improved return on capital employed, return on equity, all those things. So generally assets that are easy to securitize are that occur in large pools. Like example, vehicle loans. When banks are giving vehicle loans, two-wheeler loans, four-wheeler loans, they occur in very large pools. The number of accounts will be many. And there is some regular payment, EMIs, equated monthly installments, which are attached to it. And for which past experience can be used to predict default rates. You should also be able to ascertain the risk in it. What is the likely default in those payments? And this is possible when the pool is very large one. So you can estimate what is the likely default, how much percentage of these assets will default in future. You'll be able to predict when they are occurring in large pools. If it is small number, it's not easy to predict. For which documentation is standardized and for which ownership is transferable. Right? If a car loan, a default happens, it can be transferred in the name of the lender. He can sell it off. Similarly, home loan, it can be transferred. Right? Similarly, debts, which are the bills which are discounted, bills are assigned in favor of the institute which is discounting. So these are all transferable. There's a standard documentation and they occur in large pools and where you can also estimate what is the likely default. So these type of assets are easy to securitize. The commonly used securitizer, MBS and ABS. MBS is basically underlying asset is a real estate. It can be a commercial real estate or it can be a residential real estate. Like you and I, we take home loans, right? So the bank which is giving this home loan, that house is mortgaged to the bank. So it is a mortgage-backed security for the bank. And bank, what it does, it pools all such home loans and issues securities in the market. Investors invest money and give money to the bank, and bank realizes this money immediately. Whereas you will be repaying this home loan over a period of 10 years, 15 years, 20 years. Bank is converting this into cash immediately. And from the collection that it is making from us, so these securities are serviced in terms of repayment of interest and the principal. Asset backed is other than real estate, like your car loans, auto loans, car loans, gold loans, personal loans, credit cards, electricity bills. Okay, all those things are other than mortgage. In mortgage, there is underlying asset is a real estate transaction, where it can be a residential house or it can be a commercial property. They are mortgage-backed securities. Globally, they are further divided into two parts, RMBS, CMBS. RMBS means residential mortgage-backed securities. CMBS means commercial mortgage-backed securities. We'll be discussing that also.
Land also is included in that residential.
Yeah, land means plots. Yes, plot loan. Yes, they are also part of mortgage-backed securities. Only thing what bank sees is whether it will be able to take possession and sell it off. If that's the case, they can do it. So a plot which is properly approved and which can be sold without much difficulty can also be part of mortgage-backed securities. Can be an underlying asset. But the only land-based securitization is very limited. It is mostly real estate or commercial where there is some construction is there. The reason, they generate regular cash flows in the form of rental income also. Otherwise, pure land, no one is going to use and pay it. Suppose it's a residential one, we can be let out and you can draw rent. Similarly, commercial shops, you can draw rent also from it. So that's the reason they are popular. Only pure plots are not popular because they don't generate any regular cash inflow. You have to depend on the cash generation of that guy who has taken the loan based on his salary or business profit, whatever it is. So technically, yes, it is possible. Technically possible, but not very popular one. Plot loans are generally not securitized, though theoretically it is possible. Now you can see.
One question,
Yeah,
please.
sure.
Is how the monetization which Government of India is planning now and then is different from securitization?
This is monetization of which assets you're talking of?
I mean, they are talking about even railways also, some of the assets of the railways, like even Konkan Railway, they want to give.
Okay. I got it.
Or public sector units, they want to give it there.
Yeah, I got it. That is different. Actually, they are here. This monetization is through a disinvestment process. They are trying to sell off a portion of the equity or sell off some of the assets of those undertaking to convert into cash. This is monetization. I got 100% stake in that company. I want to convert a portion into cash. So I sell my equity portion. I retain the control by up to 51%. I will retain. Remaining 49, I will start selling in the market. This way, I convert into my stakes into cash. This is monetization. Government wants to convert their stakes into cash while retaining control of the companies.
But that is also first they will convert.
No, that is not securitization. That is not securitization. That is different. They are converting their stakes into cash by outright sell. It is outright sell.
Right. But my question is only that first, anything you want to sell it also, first you have to make say X number of equity shares for that. Then only you can sell 49% or 40%, whatever you want to sell.
Yeah, you can hold it. Yeah. Here you are there. You have some shares. You have some share capital, some stakes in that company, which you are trying to reduce. I got government-owned companies. For example, all these ONGC, BHEL, State Bank of India, once upon a time, they were 100% owned. Now, government offloaded their stake while retaining control, 51%. Remaining, they sold the shares in the market at a premium and converted them into cash, which they can use it for their own developmental activity. I want to undertake some big developmental projects, welfare projects. So where from I generate money? So my own companies are there, whose assets or whose equity I will sell off in the market, convert into cash, and that cash I will use for my projects. This is monetization by selling off your stake or assets. Some assets you can sell off. I got 10 factories, 10 plants. One plant I will sell off completely to some private manufacturer.
Is it not asset-based securitization?
No. This is different. Here, what I'm doing is, first of all, I have given certain loans. I got some receivables in my balance sheet. This I will convert into cash by issuing tradable securities. For example, what we call bonds, debentures. They are all securities, right? So yes. Similar type of securities, debt instruments, I will issue in the market. So for example, PTCs, pass-through securities, issue to the investors. They are tradable in the market. So the term used in securitization is a PTC, pass-through certificates rather, and they are traded in the market. So I have in my balance sheet, I already have certain receivables. And this I'm converting into cash. This I'm going to receive in the next 4, 5, 6, 10 years like that. I'm converting this into cash immediately by selling off these assets to an intermediary called special purpose vehicle, who in turn is issuing securities like pass-through certificates to the investors. So this is receivables which you are converting into cash. In a monetization, what you are talking about, the government is selling off its equity stake or the assets itself directly. I got 10 cement plants, power plants. I'll sell off one plant, one factory altogether, and convert that into some private people and convert that into cash. That is monetization. Or my equity shares, I will sell off. I will issue the shares at a premium in the market through IPO, right? And I will convert that into cash. So my stake will come down from 100% to say 51, 52, 55 like that. So remaining 45, I'm selling off to the private investors and converting them into cash. This is monetization from the government angle, which you are talking about. This securitization is totally different. Okay.
Okay.
Correct. Small doubt.
Yeah, sure. Yes, sir. Please ask me.
These mutual funds, they will also invest in not only shares and securities also.
Yeah,
Mutual
mutual funds are allowed to invest as per the defined scheme objective, like equities, debt, hybrid, ETFs, index funds, like that. But they are allowed to invest into these derivative products up to certain limit. They can 5% of the AUM or 10% of the issue, 10% to 5% of the total assets under management. They are allowed to invest in this type of derivative transactions.
So that means there are some caps are there by law.
Yeah, because mutual funds have their regulations very strict. They have to invest as per the defined objective. Say, for example, if they say a large cap fund, a mutual fund launching a large cap fund.
Yes.
So they are required to invest essentially in a large cap company stocks directly.
Oh.
Suppose it's a mid cap, small cap fund. So they have to invest in mid cap, small cap stocks directly. Suppose they are launching a index fund or ETF. So they have to first select a benchmark index, and same index stocks, same proportion they generally try to invest.
So they can invest in fixed deposits also.
Yeah, they are allowed to invest in fixed deposit, but temporarily, not because they have to invest as per the defined objective. But till they find some suitable investment instrument, they can temporarily park funds in fixed deposits.
It is basically a mix of the success story of mutual fund is the mix of the investments.
Yes, but as per the SEBI regulations, they have to undertake the investment as per the defined scheme objective. The scheme objective is clearly defined in the beginning. Large cap fund, mid cap fund, small cap fund, debt funds. Again, debt funds.
Once it has to be, once it is given to the public, that you should not change. You cannot change.
Yeah,
later.
you cannot change. You cannot change. They are strictly regulated by SEBI, and you have to.
So that means public should go through the document as what is the percentage of investments in different categories and what is the risk element.
Yes, what is the risk element and what is the suitability of that scheme to their investment needs, and then only they can invest. So to understand that, SEBI has given put up a riskometer. Riskometer, high risk, very high risk, moderate risk, moderately low risk, like that. This is a riskometer which is there. So
is whenever, in the website, huh?
Yeah, it is there in the website of these mutual funds, and whenever they are launching the scheme, they are supposed to show this riskometer in the documents, and to which category of risk this particular scheme belongs. They have to clearly mention. So investor, when making investment, when he is looking at the document, he will understand. For example, it is a small and mid cap fund. It belongs to very high risk category. Suppose it is
the problem is the documents are made with so small size letters. Nobody reads.
Yeah, you are right. You are right. But
yes, when I try to read, then I almost will feel that we should not invest.
Yeah, that's right. I agree with you. The documents, they look very small. That's the reason you have to rely on the advisors. Good advisor you have to select, and then to rely on his advice.
Consultant.
Or else you can open the documents on the website, and you can enlarge them and read it. If you're serious about it, you can enlarge them and read it. No harm. But you have a difficulty in identifying the right scheme. You can take the advice of a good mutual fund distributor or a investment advisor. Their services you can avail. So then you will understand it. So,
but fundamental we should know. No? Fundamental, then okay.
Yes, you must have some idea. You must have some idea which type of scheme, how it benefits you. Okay, for example, again in mutual fund, there is something called growth option and there is something called income option. So growth option will will not give you regular income, but instead what all benefits accrue will be reinvested in the fund, and that will grow in a compounding manner. But a regular income fund will invest in income generating equities or income generating debt, and that will be distributed to you on a regular basis. So if you are looking for long-term capital appreciation, you should go for a growth option.
Growth.
You are looking for a regular income, you should go for an income option. So that is clearly defined in mutual fund. That's what you need to understand. If you do not understand those things, better take the advice of a good mutual fund distributor.
Okay.
Right.
Thanks.
So
Thanks.
yeah, right.
As in the previous
So,
one, this open plots also, when we take loan, basically it is a receivable as far as the bank is concerned. Why it cannot?
Correct. It can be securitized, but the problem is, see, the guy from where he is going to pay. Now, the guy who
From
has
his
taken
salary.
a loan, yeah,
No, from
that's
his
what.
salary only. From
Yes,
his,
yes.
because his income, salary means whatever profession is having.
Right. So you are basically banking on that guy's salary or business profits you are banking on.
Yes.
What if he does not have a job tomorrow?
Oh, that is applicable for everything,
That's-
even home loan also.
That risk is there. That risk is there. Now, assuming that there is a risk. Now, if it is a residential property or a commercial property, they will generate regular income in the form of a rental income regularly.
Oh.
So that income can be distributed to the investors. Whereas if it is a pure plot, if this fellow is defaulting, I have no choice. My cash flows will get disrupted. My cash flows will get disrupted. I need to
only sell off. You have to only auction.
I need to auction and sell it off. Because open plots, they are not income generating ones.
Okay.
That's the problem. So that's why they are not popular. You can do it by relying on the salary and his business profits. You can do it. They are also done. It's not that they are not done, but they are less popular. But otherwise, the residential properties, commercial properties are more popular in asset securitization. So MBS, ABS. ABS is other than these real estate properties like auto loans, gold loans, personal loans, credit cards. Now, if, for example, you are all railways. Indian Railway Finance Corporation has done one securitization. It has leased out certain things to Indian Railways, certain properties. Indian Railways is supposed to pay to IRFC, and IRFC has securitized all that receivables from Indian Railways. I'll show you those examples. I'm going to show you. So this type of receivables can also be securitized. I'll show you as I go forward. I'll show you the examples. So you have type of contractual debts, residential, commercial, auto loans, credit card. These are some examples. This list is not exhaustive. These are some of the examples. Electricity bills, for example, the electricity bills receivable to be paid by the commercial organizations to the electricity department. That is a regular receivable, irrespective of whether
the electricity department can do securitization.
Yes, they have done. They have done.
Oh.
I'll show you. I'll show you this example. Because
the railways can do even tickets also.
No, not tickets, but where there is, because tickets you cannot accurately estimate how much it is going to be. But where you are assured of certain cash flows, they only can be securitized. So lease rentals, I've leased out something. The rentals are the lease period is 5 years. So I'm
So
sure
what
of
in
getting
the
that
station,
5 years.
in the station we get it. Okay, that can be done.
Yes, wherever you feel that the regular income is assured under the contract. Whereas railway tickets, you don't know who is going to buy, how much they are going to buy, how many people are going to travel. Suppose Corona has come suddenly.
Okay.
Now people are stopped traveling. What will happen to your cash flows? So
that means there should be some agreement. Right?
Yeah.
It means there should be an agreement of.
Yes,
payment.
very good, very good. That's a correct word. There is a contractual obligation. So suppose it's a leased property, whether there is a Corona is there, Corona is not there, still you have to pay the lease rent, right?
Yes.
But in the case of receivables from the for the public regarding the electricity bills, then how it can be securitized?
Not public, not general public, commercial organizations.
Okay.
So commercial organizations are required to pay certain minimum electricity bill. Whether they are using,
public also, we are signing
yes,
agreement.
but that is,
We are signing
that's
agreement.
right. But that is too small. Commercial organizations, they have a commitment to pay certain amount regularly, irrespective of whether they are running the factory or not.
Yes, yes.
So that is predictable cash flows and bigger cash flows.
Okay.
Whereas a residential property, you and me, there is a minimum charge, something like 300 rupees we have to pay. These are too small, right? So they are not securitized. It's only the commercial establishments who have who are supposed to pay certain minimum cash to the electricity department for using the electricity, irrespective of whether you are using or not using, still you have to pay. And that is bigger amounts. That is bigger amounts. They are securitized. So here, you can understand the process here. The company with loans identify assets to be removed from the balance sheet, and they are pooled and they are called reference portfolio. For example, all car loans, personal loans, gold loans, home loans, that's called a portfolio. So this is converted into a pooled reference portfolio, and this is sold to a special purpose vehicle. You can see the issuing company, the company which is selling the assets, it is selling this to one special purpose vehicle. It is creating an intermediary. That company itself is not issuing the securities. It is transferring the assets to an intermediary called special purpose vehicle, which is also an institution, which in turn is issuing these marketable securities to the public. Why it is done? I'll show you why the reasons I'm going to show you. So
Sir,
here, yeah.
What are the
Yes.
examples of SPV? These Carvi, AMC, etc. Are these SPVs?
No, SPV can be any another company. Usually, if a finance company, or it can be a non-finance company also.
What are the examples in the market?
What is the advantage?
Examples.
Examples. See, see, for example, it can be transferred to an NBFC. It can be transferred to a bank. It can be transferred to a DFI, or it can be transferred to any a company which is created for this purpose only.
Okay.
It can be transferred to.
In our case, IRCTC is SPV.
I'll show you. When I go to the example, I'll show you. First, let us try to understand what is this process. SPV is an intermediary created to whom the assets are transferred, and these SPV will issue marketable securities after arranging them into certain categories: risk-wise, maturity-wise, risk-wise, security-wise. They are going to rearrange all these assets. For example, all home loans are pooled and sold to an SPV. Now, what SPV does is it will categorize that. It will divide these home loans into those which are maturing in 5 years, those which are maturing in 10 years, those which are maturing in 15 years, 20 years, like that. They are called tranches. Tranches based on maturity, based on risk, right? Based on the quantity, size, like that, based on rating. So it will rearrange these assets in this fashion, and against that it will issue securities to the investors. So here the pooled.
Sir, why? Oh, so sorry to disturb, sir.
Yeah, no problem.
Why SPV? Because I think in case SPV goes into loss, the main company will be protected.
No, it is the other way, sir. It is the other way. My business risk, it should not impact the SPV. So I want to make this transaction insolvency protection from the insolvency risk or bankruptcy risk of the originating company. The company which is selling the securities. So it has got certain business risk. For any reason, I am going bankrupt.
Yeah.
My bankruptcy will not impact this SPV.
Other way around also. Other way around.
No, not other way around. Not other way around. Generally, because these are all securitized, these are having certain underlying security, and they have certain.
So they are standalone, separate. Okay.
Yeah, it is made other way around. If you ask me,
like if it is lost, then there is no. That means the investors will be losing.
Yes, it is possible in case of unsecured loans. what you are talking about, the other way which you are talking about is possible in case of unsecured loans. Like
no, there are already a lot of scams are going. We don't know. So it depends on the
True.
though loan appears to be secured, but it is on paper not properly. Suppose collateral security, whatever is given, which is given 100 rupees, shown as 1,000 rupees or 10,000 rupees. And if I sell also, I'm not getting 10,000 rupees. All these real estate, so many scams are there is only because of the over valuation of their assets and taking the loan.
Yeah, possible. See, what you are telling is theoretically possible. It's not that you cannot rule out scams. Scams do happen. That's the reason why you are involving so many intermediaries. There you are involving a process called credit enhancement, credit rating. So many things are involved. I'll tell them one by one. But the risk is there. But the risk is more in case of pooled assets which are unsecured in nature. Something like credit card dues, personal loan dues. I sold all my personal loan portfolio to an SPV. Now, SPV issues marketable securities. And this company, which is appointing another third party for servicing purpose, that fellow will go and recover those personal loans, credit card dues, and all that. And from which, the investors' money debt will be serviced by the SPV. Now, suppose the original debts become bad. That is going to hit the investors. That risk is always there in case of unsecured loans. So there, that's why you are involving a rating agency as per the SEBI guidelines. In case of India, it is SEBI. In case of USA, it is SEC. As per their guidelines, these instruments also must be rated by a rating agency. So your CRISIL, ICRA, Standard & Poor, Moody's, they will come into picture and they will rate these instruments according to the risk involved. Suppose it is pure credit card dues or personal loan dues. So the rating will be, high risk rating, something like BBB, BBB, like that, where the risk is high. But the return is also high there because, for example, credit card dues, the interest charged by the bank is something like 30 to 36%. Similarly, personal loan component, the interest charge is something like 14 to 18%. So the return is high, the risk is also high. So this is rated by a rating agency and then issued to the investors. So while issuing to the investors, the rating will be checked by the investor and see how much risk is there, what is the underlying asset, from where this SPV is going to pay us, what is the risk there. They will be able to analyze from the description of the security and the rating given to it. So if it is a personal loan or a credit card, naturally the rating will be something like BBB, BBB, like that, which is speculative type of high risk category. But the investor who is willing to take risk only will put money there because he is expecting high return also. If it is a auto loan or a home loan securitized as a securitized asset, how much return you are going to get? Because the bank itself is charging 9%, 8%, like that. How much return you will get? 1 or 2% less than that. After deducting all the servicing costs and other profits, the return paid to the investor will be less than what this originating company charging from the investor. So if it is a home loan backed securitization, the bank itself is charging 8-9%. So the SPV, which is issuing the securities, is going to give 6-7% only to the investor. They are low risk. They will have a rating, high rating, low risk. But if these pooled assets are credit cards, personal loans, then the risk is high, the return is also high. Because I am charging something like 14 to 18%. So I will pass on something like 12%, 13%, 12%, 11% to the investor. So investor will have to decide whether he is willing to take this much risk because they are being rated and the description of the security is given. Underlying assets are also mentioned. It's up to the investor who is willing to take risk because in the marketplace, there are investors who are high risk oriented, moderate risk oriented, low risk oriented. Those who are willing to take risk will invest in these high risk securities, which will give them higher returns also. Risk is there, but return is also high. Right. So that's the option is available. and which type of asset is being pulled, what is the risk involved. You check that and you select. If you think that it is worth investing, you invest. Otherwise, you don't invest. Sold to capital market investors who get fixed floating rate payments, funded by cash flows generated by the reference portfolio from which the repayment is made. Originator services loans in the portfolio collection. Originator means is the guy who is originally given the loans. Originator passes payments on, let's say, servicing fee to SPV. So in between, they will appoint one other agency called servicing agency, who will do the follow-up and recovery. And he will charge a fees. And then the money collected will be paid to SPV. SPV will pay to the investor, like that. Now, from this, you will understand the whole process. Asset originator is the original company which has given the loans or which has to receive these receivables. Underlying assets is called the reference portfolio or collateral for those securitized assets. Issuing agent is a special purpose vehicle. You can see this. Originator is a company which has first given the loans or first due to receive those receivables. And those are the underlying portfolio, transfers them to a special purpose vehicle, and who issues these securities to the capital market investors. Assets immune from bankruptcy of seller. Look at this. I think one of you asked me about this. See, this is assets immune from bankruptcy of the seller. This fellow's bankruptcy, from this it is protected, because this is against specific assets I'm creating these securities. So this fellow's business bankruptcy does not affect me, because I've isolated those assets from the balance sheet of the original company. Originator. Originator retains no legal interest in the assets because they are now being transferred. Typically structured into various classes, tranches rated by one of the more rating agencies. As I told you, once all these assets are transferred to SPV, he will do the classification act based on maturity, based on security, based on repayment preference, based on the risk involved. He will make tranches, higher risk tranches, lower risk tranches, secured, unsecured, mezzanine. Mezzanine tranches are somewhere between senior and junior. Senior fellow will get the first preference in terms of repayment. Junior, after this, only after this fellow is paid, he will get. Mezzanine guy is in between. So he will get preference over junior, but he is subordinated to senior tranche. That's how they are structured. This fellow will structure all those things in that fashion and then issue those securities to the investors. Investors will study this, understand the risk, check the rating given, and they will invest into the securities. If you look at Bank of America holds the largest asset, these securitized assets, especially mortgage-backed securities. Their investment portfolio has a very large these mortgage-backed and asset-backed securities. US security market, we can see 5 trillion. India is, this is also a little older data. India is showing 25, but latest is 2 lakh crores in 2020. Globally, the size is 7 trillion in mortgage back, and all put together, it is 11 trillion. This is the size of the market. India, it is not a great success for several reasons, because appropriate legislation is not in place, poor legal clarity, unclear accounting treatment, and high incidence of stamp duties, lack of understanding of the instrument by the investors themselves, because it's totally new concept to them. For these reasons, it is not very successful in India. But US, this has been going on for longer periods, and they already had seen 2 major problem areas. Have you heard of Enron scam? How many of you have heard of Enron scam? Subprime
Yes.
I have heard.
You have heard of it, no? Enron crisis. Enron in 2001, actually this asset securitization, special purpose vehicle, all these concepts people came to know in India only after that scam broke out. What this Enron did, Enron had a bad portfolio. bad assets, toxic assets. In technical language, they call it toxic assets, means which are bad, not easily realizable. They have pulled all those bad loans or bad receivables, and they have sold it to, they have created one SPV, which is their own subsidiary type of, their group company rather, and transferred all these assets to that SPV, which is their own creation, and cleaned their balance sheet. And this SPV issued securities to the market investors. And investors bought those securities, and they turned bad because the underlying assets are bad assets. Repayment is not forthcoming, so investors are not paid by the SPV. And when investigation was done by the regulator, it was found out that all these assets which are transferred to SPV are the toxic or bad assets. And Enron has done it to clean its balance sheet to raise further finance, and by transferring all these bad assets to an SPV. That's how the scam broke out. And Arthur Andersen, which was the consultant for Enron at that time, was banned. It was banned by the regulator, right? So that's how in India we all suddenly have become aware of this concept. We have this act passed in 2002 in India, Asset Securitization Act, called SARFAESI Act actually. This was passed in 2002. After that only in India, the securitization of the assets and all this started. But in US, it has been there for a long time. In spite of Enron scam, we had another major problem in US, the subprime mortgage crisis. The regulators have not learned their lessons properly. And you have seen another scam breaking out in subprime mortgage crisis. In subprime mortgage, in US in the early 2000, how many of you know that case? Subprime mortgage, collapse of Lehman Brothers. You're all senior people, so you might be aware of this, which happened.
Financial crisis started.
Yeah, financial crisis in 2008, 2009. Yeah, 2007, 2008. What happened in US markets, the interest rates were low in the early 2000. The Federal Reserve has kept the interest rates low, and the economy was just picking up, doing well. So a lot of home loans were given, and employment opportunities were good. So people were getting jobs, and all of them, every one of them was buying a house. So there was a sudden spurt in demand for real estate. And those who were having unsteady jobs, they were also given home loans because the asset prices were appreciating. Those who are not having regular jobs, only part-time jobs or seasonal jobs, whose job stability is not there, even they were given home loans because the economy was doing well, asset prices are going up, especially real estate prices were going up. So as long as the market is doing well in this fashion, the repayment from the subprime borrowers are those whose jobs are not steady, whose income is not guaranteed or assured. They were also taking home loans. And the moment the Federal Reserve started increasing the interest rates, suddenly this repayment has become difficult. And meanwhile, the job, people were started losing jobs because of economy is now becoming tight because interest rates have gone up, and the cost of borrowing has gone up. Investments have slowed down. Companies have started removing people from jobs. So as a result, what happened? A lot of these subprime category borrowers who have borrowed money to buy the houses, they started defaulting. And suddenly all these houses came for auction, for sale. And there are no takers because the cost of borrowing is high and economy is not doing too well. And suddenly large scale defaults happen. And these assets are pooled and securitized. And a lot of banks have put money in this type of securities, including Lehman Brothers. So many banks have put money in these type of securities. And when the accounts turn bad, when the houses are sent for sale in the auction, there were no takers and the prices crashed. And Lehman Brothers, like they do have a very huge exposure to such assets, they suffered badly and when they became bankrupt, right? So that's how the regulator, even though they have seen the major scam in Enron, and again, they did not learn their lesson properly. And they have allowed this subprime mortgage lending to flourish. even though it was happening under their very nose. They did not take proper precautions and allowed this market to grow abnormally beyond control. It was going beyond their control. And one fine day it started falling, crashing. And all these people who have invested in these securitized assets, means these bad loans are pooled and marketable assets, securities were created and sold to investors. Investors are buying because the housing boom was there at that time. Rating agencies were giving very good rating, so they started investing. And when the crash started, everything collapsed. Yeah.
One question. Recently, there was talk in the media that government is planning to have one bad bank. So all the banks which are having the NPAs, not performing assets, will be transferred to the bad bank. So it is the same securitization which it is in mind.
No, not securitization. This is not securitization. This is outright sale of the bad assets at a discount to the bad bank. Now, actually, this concept is already there in the market in the form of asset reconstruction companies. Asset reconstruction companies in this form, already this concept is there. Asset reconstruction companies, what they do, they take over the bad loans and they will try to resolve them by, by pumping in capital, raising fresh finance, or initiating recovery proceeds of their own, process of their own. They will try to make recovery of it. But what they do is initially they buy them at a heavy discount and they try to resolve them. So the same thing is now done in a very organized manner by creating a bad bank. Actually, the bad bank is not, the name is not actually bad bank, it is a asset reconstruction bank. This bank will buy out the bad loans.
Correct. But the question is when the NPA and the bank itself is termed as NPA and the banks are not getting the money from those assets. So how this reconstruction company will get back their money what they're investing to buy these NPAs?
Yes, their risk is always there. The underlying risk is intact. But what will happen here is there will be a single organization and there will be a focused effort. All the banks having different bad assets are being pooled and given to one institution, which is the bad bank, which will have that is their job. Reconstructing those assets is their job. So there is no other job that this bank is doing. They have a focused effort on reconstruction or recovery of these assets. So they will try to initiate recovery proceedings or reconstruct also. See, sometimes NPA does not mean that the borrower is a bad guy. Due to certain conditions which are not in his favor, his account has turned bad, but it does not mean that he's a willful defaulter. So what this bad bank does, or asset reconstruction bank does, it will try to first check whether this company can be revived. So it will pump in some capital, it will raise further finance for that company and try to revive that company. Reconstruction. It will revive the company by pumping in capital, raising extra finance for it, and see that the bad account turns good account. So it's a positive step. Second, if there is no chance, then they will make efforts to realize the whatever is possible by selling off the assets in a focused way, because that is their job. Reconstructing a bad account or realizing is their 24 hours job. So this
is what exactly Lehman Brothers should have done it in 2008 crisis.
No, Lehman Brothers themselves had a heavy investment. Their portfolio had a heavy mortgage-backed securities.
Okay.
Right, and they also have done some securitization themselves, and they also have invested in some securities. So the payment was not forthcoming, and it is such a swift fall, sudden fall and swift fall. They could not recover. Actually, the Federal Reserve had promised initially to pump in some capital, but they did not do. Even some banks, also tried to promise to pump in money, capital. No, they did not do. As a result, they had no choice than to declare bankruptcy. So that was the case in Lehman Brothers. Here, the bad bank concept is totally different. They will buy out the debts at a huge discount. And then they will try to restructure, reconstruct these bad loans and try to convert them into good accounts. That is the effort that they will make.
Okay.
No, if there are no chances, then they will try to recover by selling off the assets, whatever possible amount. So in the process, they will also face some risk of loss. They will face,
Okay.
but from the banks, they are buying at a discount, heavy discount they are buying.
So considering the whatever risk is involved, that they do the risk analysis and then they will
Yes.
ask for the discount and accordingly they will go for it.
Yes, that's right. That's right. Depending on the risk involved, the discount will be negotiated,
Okay.
and then it will be bought out. So in India, you have all these ABS, MBS, RMBS, CMBS, CDO, CLO, CBO. This is basically the CDO. The CDOs are basically asset-backed securities. Mortgage-backed underlying asset is real estate, which is MBS, RMBS, and CMBS. This is two varieties under MBS. Real estate, residential mortgage-backed securities, commercial mortgage-backed securities. Asset-backed commercial papers. These are all long-term, and this is short-term. Commercial papers are short-term. It's a money market instrument. They are issued for 1 month, 2 months, 3 months, less than 6 months usually. So this is also a securitized asset, but short-term, less than 1 year. These are all long-term debt instruments like bonds and debentures. These are long-term instruments. This is short-term. Yes, sir. What is that you are asking?
Give examples for these in India. Which are the companies or what are the things?
Yeah. Yes. I'll come to that. Sir. I'll come to that. Now, what is the advantage of doing this securitization for the issuing company? It will reduce the funding costs. But if I have to raise fresh capital in the market, that will take a lot of time and it involves cost. For example, I want to go for an IPO or a private placement. Heavy cost is involved, time is involved, cost is involved. So securitization, my cost comes down significantly. Reduces asset liability mismatch. Because I have a liquidity problem, I can overcome by converting these receivables into cash. So I'm managing my liquidity better. Lower capital requirements. Remember, this is another problem for a lot of financial institutions. Under capital adequacy norms, I need to raise capital based on the risk-weighted assets. So when I'm creating an asset in the balance sheet, it carries certain risk and a risk weight is assigned to those assets. And the value of that asset is multiplied with the risk weight, and then it is summed up called total risk-weighted assets. On that, I have to maintain certain minimum capital called capital adequacy ratio. I think finance people know what is Basel norms. I think if some of you are finance people, you know what is Basel norms, right? And capital adequacy norms. Under this, you are required to maintain certain minimum capital on your total risk-weighted assets. So every asset you are creating, like every loan you are creating, every receivable you are creating in your balance sheet, it carries certain risk. So based on that, certain risk weights are to be assigned. You multiply that risk weights, the value of the asset with the risk weight, and then you total it up. That is called total risk weighted assets. On that balance, you need to maintain certain minimum capital called capital adequacy ratio. So if you are converting them into securitized assets and you are selling to SPV, your total risk weighted assets are coming down and your capital requirement will also come down. That's advantage. You don't have to raise extra capital if you are using this securitization process. Locking in profits, because you are immediately converting into cash, you are realizing your profits immediately. You are transferring the risk of that investment receivables to the investors now. Investors will face the risk of credit default. Beneficial to balance sheet because now it becomes cleaned up, all your receivables received, so cleaned up. The balance sheet is cleaned up. So better balance sheet, better liquidity. This is the most important number one advantage is better liquidity. You are managing your liquidity better. Okay, now this comes to disadvantage of the issue, may reduce portfolio quality. Suppose the good portfolio is there, the portfolio is good, let us say. So he will realize better returns if it is a good portfolio. But by selling off, the cost and all that will reduce your return if it's a good portfolio. So any securitization also involves costs because you are creating intermediaries, you are meeting their costs, size limitations. So everything cannot be securitized. Only with certain minimum quantum is there, that only can be securitized. So it is a limitation. Risk is ultimately if the accounts turn bad and investors are not getting payment, the reputation of the originator will also take a beating. That risk is there always. Though you are transferring the risk temporarily to the SPV and who in turn is passed on to the investors. Ultimately, if those assets are not realizing, investors are not receiving the money, originator will also face some reputation risk. Right. So from the investor point of view, investor can select the instrument based on the risk, because the SPV, what it is doing, it is classifying all these assets into different categories based on maturity, based on the interest, based on the security, based on the risk. So they're called tranches or parts. Into different parts he will divide, get them rated, and then release it in the market. So investor can now easily understand, okay, how long I need to wait to get my repayment, how much risk is there, am I getting a reward, enough return based on the risk I'm taking. All these he can analyze and select the instrument. Right. So this is possible for the investor. Invest in a specific pool of high quality assets. Suppose he is looking for only high quality assets, he can select only those securitized assets and invest there. It will help him to diversify the portfolio because now he has a wider choice of investment. Isolation of credit risk from the parent entity. So parent entity's business risk is not passed on to the special purpose vehicle. So it is free from that risk. Now we can see what we have discussed earlier. A process is a issuer, is a lender, is a originator, also known as originator, original company. Okay. Issuer is the SPV. Investors are the money who are buying it. Is the issuer. These are all the original borrowers. Is a broker basically arranging these parties and he is lending to them. So this is between. Now they are sold, securitized. Their pooled assets are sold to issuer. Issuer is issuing these securitized assets to the investor, and then he is appointing one servicer, servicing agency, who is recovering from this borrower, and then the payments are passed on to the issuer, who in turn is servicing the investors. So in between, he is also creating certain other intermediaries like trustee, underwriter, rating agency, credit enhancement provider. So as you go deeper, this has become, as it becomes more and more organized, more and more regulatory restrictions are there. Now you are involving more intermediaries to make it much more safer for the investors, much more organized transactions. Trustee is a watchdog. He will see that the investor's interest is protected. They are not being duped. Underwriter is a guy who makes sure that these issues are subscribed. If it is not subscribed, he will step in, and the unsubscribed portion, he will subscribe. So SPV is issuing those securities. They may not be fully subscribed by the investors. The unsubscribed portion will be picked up by the underwriter. Then rating agency will rate the instrument according to the tranches which he is creating. And credit enhancement provider will suggest how to reduce the risk.
Excuse me, does the underwriter underwrites before issuing or takes the balance left
At the
over?
time of,
Because
at the time
in
of,
many of the cases,
yeah.
like for new projects launched or something, underwriters firstly take a good chunk of it, and rest of that is sent to the market.
No, it is like this. The general procedure is that underwriter gives a commitment in the beginning. Okay, I'm ready to underwrite up to this portion, this much.
So
So
he reserves.
he gives a guarantee. Okay, if there is under subscription, I will step in and subscribe to this extent. It's not a single underwriter. There are several underwriters. So they all come and underwrite the issue. So each one underwriter guaranteeing certain portion like that. Now, and the issue is then made to the public. If under subscription is there, underwriter will step in and subscribe that. This is how the normal procedure is there. But in US, what happens in an IPO type of situation, the issue is sold out to the underwriter. An underwriter will market and sell it to investors. Whoever has underwritten to that fellow, the issue is sold out at that price, a particular price. He will market the issue to the investors. That's in IPOs. That's how it happens. But normal underwriting process in India, for example, it's they give a guarantee. Okay, we undertake to subscribe if there's an under subscription. To this extent, we will give guarantee, and they charge a fees for it, underwriter fees. This is how it happens in India.
Sir, you mentioned about the cash flow only securitization, but here you are telling about the borrower itself. How it can this may be the customer or it is a borrower, sir?
Customer here is the see, there are investors, there are borrowers.
No, this lender to this thing. Told only cash flow can be securitized.
Yeah. Okay.
Borrower.
Borrower is the lender has created the assets in his balance sheet. For example, SBI, State Bank of India, ICICI Bank, SDFC Bank, they have given a lot of car loans, home loans. So there is a car loan borrower, home loan borrower. They are called borrowers. It can be a borrower, or it can be a debtor in some other form. Suppose electricity, I'm using electricity. I have to pay electricity bill to the electricity department. I am the debtor for the electricity department. So I've used the electricity, I have to pay charges. So I'm a debtor. I may not be a borrower. I can be a debtor also. Borrower is one example. It can be a home loan borrower, personal loan borrower, car loan borrower, like that. It can be a borrower, or it can be someone who owes money, like electricity users. They owe money to the electricity department, like that. So it can be any of those people have to pay. Yeah, please tell me.
For borrower, one fine day he will find that he will have to repay now not to lender but to servicer. Is it so?
Yes, because these payments are assigned. Assignment is done. All the receivable are assigned in favor of the issuer.
Yes, sir.
Right now, so this fellow will be paying to the issuer directly through the servicer. Servicer is the guy who is actually collecting money and giving it to the issuer, like collecting agents. They do the collection and give it to the issuer. Issuer will make the payment to the investor. So he is out of the picture. His balance sheet is cleaned. Now appoint a servicer who will do the collection. So this fellow's balance sheet is cleaned. But he faces the reputation risk. Suppose this fellow does not pay. This fellow does not pay at all. Then issuer will have to sell off that asset, auction that asset, realize, and then pay to the investors. So in the process, they may suffer a loss. If that happens, then this fellow's reputation is at stake.
Yes.
Reputational risk he will face. So that problem is there. But this is all done in a very organized, structured way. Investors will select that instrument based on the risk involved. So if it is a auto loan, personal loan, or a credit card use, something of that sort, underlying asset, they are taking very high risk. The rating agency will give a very low rating for it. But the risk reduction methods, they are called credit enhancement. Through a process, the risk is divided and structured in such a way that high risk, moderate risk, low risk, it is structured. So the overall risk reduction is done through the structuring process. For example, creation of the senior debt, mezzanine debt, junior debt. So by subordinating the payments of others to this, first you have to pay to this securitized asset people, then you have to pay to other people. Like that, if you put a stipulation, you create the instrument in that fashion, this way the risk is reduced. First you have to pay to the senior debt guys, then the mezzanine debt guys, then the junior debt guys. So the risk is, as you go to the junior level, the risk is higher, return is also high, but the risk is also spread out now. And investors who do not want to take risk will invest into those instruments which carry the senior debt category, enjoys the senior debt category in terms of repayment. You go to the next level, mezzanine debt, little higher risk, but they will enjoy preference over the junior debt in terms of repayment. So investors know that, okay, in the event of this borrower defaulting, when the asset is realized, the payment will first go to the senior debt guy, then to the mezzanine debt guy, then to the junior debt guy. They know that in that order it will be realized and paid off. So they know the risk involved, how it is done, because this is done through a credit enhancement process, dividing these into the junior, mezzanine, and senior category. You are making the risk very clear to the investors. Then also credit enhancement through over collateralization. There is another method called over collateralization. In the sense, the securities issued, the value of the total securities issued is less than the total security value itself. This way also you can reduce the risk. Suppose the underlying assets value is something like 100 crores. So what I do is I issue the securitized assets to the tune of 80 crores only. 20 crores I'm keeping as a big margin. So in the event of defaults happening, so when I'm selling off the assets, I'm able to clear the entire 80 crore because the value of the collateral assets is much higher. So my issue value will be less than the actual security value. So this is also called a credit enhancement process, over collateralization. Then maintaining good spreads, another method is there. So basically my receivable return is something like 12%. So I'm offering you only 8%, but dividing them into high risk, moderate risk, low risk. So low risk, I'm giving you at 8% or 7%. Low risk, there's no almost nil risk like that. I'll offer you only 7%. So this way, you know, when I'm realizing 12% from the guy, I'm paying only 7% to you. I'm building up good reserves, which I can use for repayment in case of future defaults. This is, you know, a good, creating good spread, margin spreads, over collateralization, margin spreads, then dividing these securities into senior, junior, mezzanine, like that. So you are trying to reduce the overall risk in the securitization process. This is called credit enhancement, what they call. So this is all done in a very structured way, organized way, with a proper regulation, intermediaries who have a different functions, a well-defined, clear functions. Trustee's job is to see that the investor rights are protected and the money is not diverted or misused. Underwriter makes sure that the subscription is made. Rating agency gives the risk rating based on the instrument classification. Instrument is classified and then the risk rating is done based on the underlying risk. Credit enhancement is through a process wherein you are dividing them into different categories, different tranches you are creating. Senior debt, mezzanine debt, junior debt. One method. Then over collateralization. So basically, the securities issued are the total value of securities issued are much less than the overall underlying assets value. This way, you are protecting against any shortfall in the receivables. Still, you have a good margin, which you can still pay to these guys, because my value of the assets is 100 crores. I have issued the securities to the tune of 80 crores, 75 crores. So I keep a good margin. This is another method of reducing the risk. Then keeping a good spread, I'm creating a reserve. I'm receiving 12%. I'm paying you 7%. I keep a good margin, but I'm giving you full security. Rating is very high, giving you full security. I'm giving you 7%. My collection is 12%. This way, this is good spreads I'm creating. And through these spreads, I'm creating reserves. And from that, I'm able to service my debts to the investors. These are all different methods done in a very organized way, structured way. So this is the same thing, which is advantages, disadvantages. Now I'll show you some of the examples. All of you are able to see this?
Yeah, okay.
Yeah.
So this is Citibank GIC mutual fund in 1990, 160 million rupees securitization deal was done. Citibank has pooled assets and transferred to GIC mutual fund in 1990, where you know that mutual fund regulations were not strict at that time. So at that time, this was done. You can see Rajasthan State Industrial Development Corporation, structured by SBI Cap. SBI Cap is an investment banker. He has arranged the securitization for Rajasthan State Industrial Development. It has to receive cash flows from high value customers. This is securitized and sold in the market by SBI Cap. UP government, payments of UP government to HUDCO by tax-free bonds worth 500 million. UP government has to pay to HUDCO. And these receivables from UP government are converted into securitized assets and sold in the market for 500 million rupees. Sales tax deferrals means you have to pay sales tax, but I'm giving you time to pay. So there are accumulated sales tax. They're called sales tax deferrals. The government of Maharashtra has to receive sales tax deferral payments from its clients, the users, the industrialists. And they are securitized 1,500 million rupees and sold in the market. Now here you see electricity, Karnataka Electricity Board has pooled its receivables to the tune of 1,940 million and placed them with HUDCO. Jet Airways 16,000 million dues, the receivables are being securitized and sold through an SPV. Offshore SPV means not within India. This is located outside India. ICICI has securitized 27,500 million in 1999. Different loans. Some more examples. Now let's come to the infrastructure people also. You can see L&T has raised 4,090 million through this securitization on future lease rentals receivable for its power plant. It has leased out the power plant and future lease rentals receivable. It is securitized to the tune of 4,090 million in 1999. Personal loan portfolio by Citibank, they have securitized to the tune of 2,841 million in 1999. National Housing Bank, 597 million mortgage-backed securities. They have securitized. And this is Jet Airways, the same thing. Now, Government of Maharashtra, sales tax deferrals are being securitized. Karnataka Electricity Board, which I already discussed. ICICI Bank, first CDO issued by ICICI Bank in 2002. First floating rate securitized instruments issued by Citigroup to the tune of 2008-10, where the interest rate is not fixed. it linked to certain reference rate like repo rate. Indian Railway Finance Corporation, first sovereign lease receivables by IRFC, 1,960 million rupees. This is lease rentables payable by Ministry of Railways to IRFC. Now this is being securitized in 2005, 1,960 million rupees. And it's all 1,196 crores worth the receivables to be received from Ministry of Railways is securitized by IRFC. And in 2007, India's largest deal done by ICICI Bank, auto loans, means car loans like that, they are pooled and securitized by ICICI Bank to the tune of 19,299 millions. So these are some of the major deals, securitization deals that have happened in India. Okay.
Somewhere you mentioned the word green shoe option. What was that?
Yes. Green shoe option is the option to retain oversubscription to some extent. The some extent is 10 to 15%.
Okay.
See, I'm going for a public issue. I'm issuing certain number of shares. But the subscription, the issue is oversubscribed. So what do? I have an option to retain oversubscription. I want only 100 crores. But I've received applications for total 200 crores. Out of which I will be allotting 100, remaining 100 I will be refunding. In a normal procedure, I am going to issue 100 crores, but I have received applications to the tune of 200 crores. That means my issue is oversubscribed to the extent of 2 times. Normal course, what happens? The oversubscribed portion will be refunded back to the investors.
Yes.
But in a green shoe option, I will retain the oversubscription to certain extent. That certain extent is 10 to 15%. Okay.
Okay.
So what do I do with this money? I will normally this green shoe option, this money, the oversubscribed portion which I'm retaining is used for market making. Means these shares will be used for market making in the sense if in the marketplace someone wants to buy or someone wants to sell, there has to be some opposite party, right? If there is no opposite party, these market makers will act as opposite parties. That means they will create a ready market, even if there is no genuine regular buyers and sellers in the market. I will act as the counterparty. Now you have, let us say you have applied for a particular share. And after 1 month, after it is listed, and after 1 month, you want to sell the share in the market and you want to make exit. And you have put your shares for sale. There are no buyers in the market. What will happen? You will not be able to exit, is it not? So in such situation, these oversubscribed shares which are retained by the underwriter, that shares will be used as market making. Means that fellow who has the company will act as the counterparty. And I want to sell, they will become buyers. I want to buy, they will become sellers. This is called market making. So to make the market, these extra shares are kept ready, which is called the green shoe option. Okay. It is called green shoe because this facility is first allowed in a public issue of a company called Green Shoe in USA. And since then, this word green shoe option stuck, and we are using the same name.
Okay. So is it not, venturing into something what one is mandated to?
Yeah, see, they are in a public issues, especially book building type of public issues. The regulator mandates that market making has to be there, especially companies which are not having an established track record already, but their project is appraised and funded by certain agencies, and they are giving loans, and they are allowed to go for public issue with 50% institutional participation. But in such case, the SEBI says there must be 2-year market making. That means if some investor wants to sell in the market, if there are no buyers in the market, you have to make arrangement that the shares sold by the investor in the market are bought out. Similarly, someone wants to buy. If there are no sellers, you must make arrangement for selling the shares, for which you are required to retain certain extra number of shares with you. You will be acting as the opposite party. So usually underwriters do this. They act as the counterparties. And so this right to retain the extra oversubscription by the underwriters is called the green shoe option, which is used for market making. And this is as per SEBI guidelines, the regulators' guidelines. So this is your own Indian Railway Finance Corporation, securitization. Right, now this will talk about the SPV. Who is this SPV? Is a legal entity, usually a limited company of some type or sometimes a limited partnership. So you are creating a separate entity called SPV, also known as special purpose entity, SPV or SPE. So there is a sponsor for this. The sponsor can be an outsider, or this fellow himself can sponsor and take the participation by others. This fellow means the originator. Isolation of assets provides comfort to the investors because it will make it bankruptcy or insolvency risk free of the originator. Assets distance from the parent company. So this fellow cannot touch it now. And this money cannot be diverted. The money which is, these assets money which is realized has to be used for payment to the investors. So assets are distanced from the parent company, and they are isolated from the bankruptcy risk. And the payments which are realized will be used only for payment to the investors. This is ensured by the trustee who has been created in between. Performance of new entity not affected by the ups and downs of the originating entity. SPV will be subject to fewer risks and thus provide greater comfort to the lenders. Because these are all focused assets. These are all specialized assets, focused assets. So the risk is also, you're not carrying a generic business risk. The risk is only specific to these type of asset class. So a focused one, so the risk element is also much lesser as compared to the overall business risk of the originator. A parent company creates SPV to sell assets on the balance sheet and obtain financing. This process I've already showed you in diagram form. Now, SPV can be regarded as a bankruptcy remote entity because of the manner in which it is created. It's basically done to isolate assets sold to SPV from inheriting the risk. Same thing, it is being repeated here. SPV is unlikely to go bankrupt because it has got specific assets, underlying assets. Now, this is being how it is abused. This securitization process is being abused. As I told you earlier, the example of Enron, which has hidden losses to fabricate earnings. What they have done, they have transferred all these loss-making assets to an SPV. Several executives of the company were found guilty of the securities fraud, served prison sentences and paid fines. All this has happened in case of Enron. And Arthur Anderson is the consultant who have suggested this, this SPV process in case of Enron. So that's how it was. That's how it was abused. The SPV process was abused in case of Enron. So administrator, seller, SPV, liquidity provider, credit enhancement provider. These are all the different entities involved, which we have discussed. The security certificates are called pass-through certificates, PTCs. What he's issuing, they are known as technically PTCs, pass-through certificates. So these repayments are passing through the SPV from the original borrower. Money collected and it is coming to the SPV, and from him it is going to the investors. That's why they are known as pass-through certificates. India, this act was passed in 2002 and securitization was allowed. After that, in an organized manner, this is being done. After this act, everything is well structured, done in an organized manner. There are regulations. Even before that, securitization was done. But after passing this act, the proper regulations came into picture. Now change the PPT quickly. Look at this mortgage-backed securities. As I told you, RMBS, CMBS. The meaning, RMBS is residential properties, CMBS is commercial properties. The intermediaries are same: borrowers, originators, trustee, service provider, issuer, investors, and rating agencies. This is the same process. Again, here, this is RMBS, CMBS. And within this, you can see there are stripped mortgage-backed securities. This is available in US markets, where the securitization is done only for principal and only for interest. This is innovative products which are there in the market. Only principal is securitized separately and only interest is securitized separately. They are called stripped mortgage-backed securities because these two are separated. Principal only, interest only. Again, fixed rate, floating rate, mortgage-backed securities. Fixed rate, floating rate. This is floating rate. Now, these are all the CMBS, RMBS, CD, post. Now, you see how they are whole loans, mezzanine loans, subordinated loans. Like that, they are being divided. Now, I'll show you what is the outstanding business that is being done. You can see this is RMBS in US markets. See how it grew in 2007, 2008. 2007, it was 788 billion US dollars. Actually, 2006, it was even higher. Then the default started and, RMBS started falling. And again, in 2019, again, it came down to 63.7. So this business is going down. Coming to CMBS market size, this is also going down. Because of the delinquency rates, means the default rates, because the defaults are going up, the business is also slowly falling. You can see it was peaked during 2007, 2008. Subsequently, it fell down, improved because of delinquency rates, means default rates. You can see how it has fallen in 2020. Because you can see here it is mentioned, the delinquency rate in US CMBS has hit a record 6.17% in May 2020, as reported by Standard & Poor's. So US, they have their own share of problems. Here, the default rates are going up. So the business is also coming down. You can see how it came down. Same is the case with CMBS also. Right. So in short, this is a type of a financial innovation. It will help a good company, a genuine company, to manage its liquidity assets in a better way. If it is a genuine good transaction, the issuing company is able to rotate its funds faster, manage its liquidity better, and improve on its return on capital employed and return on equity in a genuine case. Investors also will have a wider choice, better options, okay, and they can also diversify their portfolio risk. And they have an option. I use the word option because these are classified into different categories and sold as customized instruments, structured instruments to the investor. So investor knows which is a high risk one, which is a moderate risk one, which is a low risk one, which is long term, which is medium term, which is short term, which is senior, which is junior, which is mezzanine. he knows because the classification is done. So he can understand the risk and invest into those type of securities. So this way, this is a financial innovation which has happened over a period. Abuses happened, but after that, the regulations have become a little stricter, and the market got stabilized. The Indian market is also growing steadily, which was only 25,000 crores some 7 years back, is today 2 lakh crores. So Indian securitization market is also going up. Globally also, it's a very big market, 11 trillion market, out of which the mortgage-backed securitization is something like 7 trillion. So you can see the overall global markets are also growing. So securitization as a concept is now well established and it's growing. The risks are there, but the regulations are improving. Investors' rights are protected. Investor has a choice to make his selection based on the risk which is available and the rating that is being done to those instruments. And to improve the risk, to reduce the overall risk, credit enhancement process is being created, which will try to protect the interest of the investors. So this is in short about securitization. Anything you want to ask? Anyone? Any questions? Pushpa ma'am?
How is this CMBS performing in India?
Indian market, we have 20,000 crores, 2 lakh crores, out of which 77,000 crores are pass-through certificates. So which is mainly in the form of the mortgage-backed securities. So we have 77,000 crores. So which was earlier something like 10 to 12,000 crores way back in 2015, like that, 2014-15. Now it is 77,000 crores. That means it is showing decent growth.
So
it is good.
The target that we are making for 5 trillion economy, how much is likely to be the component of this?
No, it is still, see, securitization is still in nascent stage. If you are talking of GDP, contribution to GDP, it is still very small. See, it's not that big market in India as of now. So if you are talking of the contribution of this to the GDP, it is in single digit. That too in the in something like 1%, 2%. It's much smaller in size and contribution to the GDP. It still has a lot to do in terms of growth. I use the word nascent stage, means still in a developing stage.
Can we identify some steps which are being taken in that direction?
See, the more and more securitization by the banks. See, banks are also, they are hard pressed to improve their liquidity. So banks are involved in the process of credit creation. So banks, banks are the people who are first taken the initiative and started doing the securitization. As I gave the example of ICICI Bank. ICICI Bank has created the largest securitization pool, 27,000 crores. So banks are taking initiative and trying to use this as a good tool to improve their liquidity.
In wake of a lot of failures of some of the banks and financial institutions, is it there a negative trend in this in India?
No, as of now, there is no negative trend. It's only positive trend. Because from the figures you can make out, it was 2015, as I told you, something like 25,000 crores to 2 lakh crores now. That means the trend is not negative, trend is positive only. But as I told you, there are certain structural problems, legal structure in terms of recovery, taxation, recovery, understanding of the instrument by the investors themselves, because Indian investors are still, that awareness is not there. There are very limited investors who are getting into this. So unless an awareness is created, more high net worth individuals are made aware of this and they get into these things, then the spurt or a sudden growth in this will happen. So in this, the investment bankers, the wealth advisors, private banking people, wealth advisors play a big role, when they are advising the high net worth individuals to create an awareness first. There are such instruments which are available in the market, which will help you to diversify the risk. So once that awareness is created and investors are willing to invest, the real growth will happen. So till that time, yes, because in high net worth individuals, the growth in high net worth individuals itself is very slow in India. So number of people who are getting into this is also very slow, so small numbers. That's why the slow growth. And the legal structure in terms of recovery is also to be improved. Once that becomes good, the legal system is very strong and recoveries happen, then more and more securitization will happen. Because investor can't take the risk of a default and then wait indefinitely for recovery. If that structure, recovery structure is like that bad bank, as I told you, one such step where asset reconstruction is happening. So underlying asset quality will improve, the recovery process will improve, it will become better. So securitized instruments will also be more efficient. So overall structure, legal structure, the recovery structure, everything will improve, then the securitization will improve. So that's the process.
This more or less seems like a trading in loans, trading of debt.
Debt instruments. Yeah, you are right. You are right.
There is nothing tangible in that.
Yes. Essentially, it is a debt. It is a debt instrument.
Is okay.
Essentially, debt instrument. Underlying asset is also a debt instrument. It's a derivative. It's a derivative transaction. Underlying transaction is a debt transaction.
It's not a real money.
No, money is involved because someone owes you money, right? And he has to pay you. Against that, you are creating another derivative instrument. It is a genuine, it is not a fake or some fake transaction, which you are trying to create a derivative. No, there is a genuine loan transaction or a receivable transaction, which is there outstanding. Against that, you are creating this derivative transaction. So there is no fake transaction. There is no fake transaction here.
The honest countries, the securitization will be much more than the otherwise, because the risk of delinquency will be much lesser there.
Yes,
compared to other countries.
Yes. As of see, you see that data is not fully out. You cannot say, I cannot really make a comparative study like that. US market was good, but US market had a major problem in 2007-2008, after which that Dodd-Frank Act was passed, and then a steady improvement has happened in securitization process. But of late again they are facing delinquency problems. But there is no comparative data available how it is so in other countries. But India, since it is improving steadily, it means we are not having that type of problem, because the rate of growth that has happened, that means that things are going well. So as long as that is doing well, underlying assets are doing well, securitization will flourish in India. As of now, there is no problem in India. Okay.
Sir,
yeah. Mr. Kumar Vayalan, sir, are you there? You have joined?
Yes.
Yeah.
So if you can take break.
You want to address them, right?
Yeah, okay. Just for 10 minutes, and then you can come back maybe at 12:15, so that they have break of 15 minutes at least.
Sure. Okay, so we'll take a break here. Mr. Kumar wants to address you on some important aspect. So I will hand over to Mr. Vayalan Kumar, right? Okay. Thank you. So we'll reassemble at what time? It's 12:15. Okay, fine. Yeah. Fine. Right, I hand over to Mr. Kumar. Right.
Thank you. Yes, officers, good morning. So yesterday I posted a message regarding the project assignment which you are supposed to carry and submit it to Ctara in your second spell, and wherein we will also have a presentation in the last session. Okay, so on the project that you will be doing. So can we quickly try to have some kind of consensus on that as to how do we plan and what is your plan as of now, which area you would like to focus on. Of course, it will be on project management because this subject, this particular training is on project management, which also focus on alternate financing. If you want to club these two, project financing and project management and financing aspect, you are most welcome to do so. So yesterday I also made it clear in the message that whoever is not from the technical background, they can always pair up with others. And the idea is to do a good project out of this exercise and submit the soft copy to Ctara for records, and also, you know, wherever they want to use it for the benefit of next program, maybe, you know, so the officers of next program and so on. So can we just discuss for next 5 minutes as to what is the tentative plan that we have as of now?
I will like to do a project on workshop project.
Workshop
Project. It is an office in Patna which sets up many projects for Indian Railways, and it has set up a rail wheel plant Bela at Bela. So it is 1400 crore project, and there is time and overlap is there. The project is not completed.
Okay. So may I know, ma'am, which area are you coming from? Which background?
From Bihar, Patna. I'm from finance.
No, I'm saying technical. Is it technical service or is it finance service?
Finance service.
You are from finance service. Okay. So fine. So someone from technical service can join you. Okay. So or if you are confident, you can take it on your own. Fine, no problem. It is up to you. So
I'm taking modernization of bridge workshop at Lucknow.
Modernization of
bridge workshop, engineering bridge workshop. So that process is on, and so that
the project has started, sir.
Project has started. Yeah, it is
already. And what would be the tentative funding, approximate funding?
Funding is around 48 crores only.
48 crores.
Yeah.
Okay, so small project, fine, no problem. You can take up that. And are you from technical background?
Yeah, of course.
So, okay, what is the stage of this project now?
It is at the final stage of implementation.
Okay, final stage of the implementation stage.
Yeah, final completion stage.
Completion stage. Okay, so you would like to examine it critically, okay, as to when it started and if there is any delay and, you know, such issues and what are the reasons for the delay, right? And so on, so that that should become a guiding force for the next project.
Correct.
So because the project has to be completed on time, you know.
Correct.
That's what, you know, you have heard about finance, how you know, what will be the bearing on the finances of the organization if the project get delayed, right?
Correct.
Yeah. Okay. So fine. So you would like to do it on your own, alone?
Yeah. I mean, I'm there. I can do it.
Okay. Fine. So fine. So others, please. Any other?
Yeah. This is Alok Tiwari, and I am from civil engineering background, and we have executed many projects during last 30 years. So I like to do some case studies that why in Indian Railways there is a time and cost overrun. Most of the project it is always delayed or the cost overrun is there. So we will study why it happens, and so what can be done to prevent it. Those cases.
Okay. So for this, I would say, are you from finance background?
No. I am from civil engineering background.
So sir, I would suggest that especially for your project, if we can pair up with someone from finance background, I think you will be able to do justice to that.
Yes.
So because there is a lot of financial related issues in that. So let's see, maybe somebody if someone is willing to pair up with you. Yeah.
I'll be happy to, from which place sir belongs to?
No, ma'am, you are trying to work on the workshop, right?
Workshop project is a mechanical engineering project,
Yeah,
and it is setting up mechanical and
he's talking of different lines. So he's saying the other projects why projects are getting delayed. So if you are
these
taking
workshop projects are also being delayed.
Okay. Yeah.
Pushpa, I'm SK Gupta. I shall join you. I'm
Yes.
from electrical background.
Yes, yes.
Do the workshop study.
Yes, yes, yes.
Yes.
Okay. So then you both can work on one issue, right? One project.
Yes.
Yeah. Yeah. Fine. Thank you. So yeah. Others, please.
Srinivas, sir.
Any suggestions from others?
Good morning. I'm Srinivas. I'm a civil engineer currently working for Central Railway. I am currently working on what are the modern technology available to monitor the project using latest technology like drones, etc. So since I'm already on the job, I would like definitely I'll be completing another 3-4 weeks time. So I think I'll make a good project on that. Is that okay?
Shall I join with you, sir?
Yeah, sir.
Yes, get your
Welcome.
seat, sir.
Welcome.
Yes, sir. Thank you, sir.
Yeah, fine. Which area are you from, sir?
I'm from Secunderabad only. I met you.
I know Srinivas ji is from technical.
Yeah, civil.
Oh, ikkada.
Hello.
Civil engineering side. I'm from civil engineering.
So engineering.
Yeah, civil engineering.
I am from electrical.
Okay. No. Are we saying you three would like to work on that?
Yeah. Myself and Suranjan both will be working on this.
Yeah. Oh, it's better if you have two rather than three. Yeah.
Correct.
So no. My question is, are you both from technical? Or
Yeah. Both from technical actually. He's from electrical. I am from civil.
Okay. So fine. So would you? I think you have some knowledge of finance also, right?
Knowledge of finance also, because currently I'm working on that. I had to finish one project.
Fine. Then fine. Yeah. The issue is, in case if somebody is only from finance without technical background, so obviously we would like to have somebody pairing with him or her because this is on project management primarily. So that's the reason. So if you have some finance knowledge, you can always take up that. So that is fine, no problem. So fine, sir. Next, yeah.
Me, sir, I am technical.
Okay.
So no finance background much.
Okay. Who is this, please? Hello.
I am from Hyderabad. Sir.
You are from Hyderabad. You are from pure finance background.
No, pure technical background.
Pure technical background. Okay, pure technical background. So maybe you can seek help of somebody who is from finance background here.
Yes, sir.
And maybe collectively you can do a better job. So someone would like to work with her, please.
Can I join Pushpa madam, sir? There are 2 people already. So if I can join, I can learn some financing.
If there is none, then we will look at. If there is none who's volunteering to work, or maybe because of the lack of interest in that particular project, so then maybe we will try to explore that. So let's see if someone someone can try to work with you.
Yes, sir.
So anyone, please, anyone who have heard Padmavati ma'am about her interest, so would like to work with her. Hello.
You are from which department?
S&T, sir.
S&T. Then you join now this drone monitoring project.
Yes, sir.
Yeah.
If 3 persons are possible, then it is okay for us.
Your choice. You want to learn finance, you can join that finance person.
Sir, Srinivas, sir, your offer is better, sir. I'll join. There's some mobile project you were telling.
Yes.
I'll join that, sir.
Yeah, do join that. Yes.
Sure, sir.
Okay.
Thank you, sir.
So, okay, that's finalized, ma'am?
Yes, sir.
Yeah, okay, please. Yeah, others who are...
I am from technical background, SNT.
Okay.
I can do my own any projects. I am doing lot of projects on my side. I can individually do my project.
You can do it individual level?
Yeah, it can.
Yeah, so on which area you would like to work, sir?
Signal and telecom modernization.
Okay, so you have basic knowledge of finance?
Some idea. Basic idea.
Some idea. Okay, so maybe if you can draw concepts, whatever concepts that are explained here, if you can correlate and try to take help of others, maybe in your department, the finance people especially. Okay, if you can take some inputs, so that will turn out to a better project.
Right, sir.
Yeah. Right. So yeah, okay. So others, please.
I am N. Balaji. I am from Chennai, sir. So our ICF EFA is there, sir. Mr. Singaya, sir. So we both in Chennai. So I am from electrical background. He is from accounts. So we will combinedly we will do some project.
Okay, so it was not clear, sir. Are you from technical background or
yes,
finance?
sir, I am from technical background, electrical, sir.
Okay, technical background. Okay.
So PFA, sir, is also there. So PFA,
okay. So fine. So let's see if someone wish to pair up with you. Anyone, please? Anyone who heard him about his project, his interest in that particular project?
Who, sir?
Anyone here?
I can join, sir.
Okay, who is sir? Plus, can you please name?
DP Garg.
Okay. So you're from which zone?
SNT department, sir. SNT.
Okay, fine. So is it okay, sir? So we wish to join you.
Who are all, sir?
Hello.
I am DP Garg, CST project NCR.
Yeah. Do you know him?
No, sir.
I don't know.
Okay, is it clear? Is audible?
Yes, sir, audible, sir.
So he says he can join with you. So is okay?
PFA, ICF is also there, sir. 3 people will be there.
Yeah, fine. So you both will be able to work on that, right?
Okay, sir.
Okay, sir. Okay. Thank you. Yeah. Anyone left over here is yet to get some project assigned? Hello. I hope all are covered. So, Garg sir, are you into some project with others? How about Reddy sir here?
Garg sir is with us now, sir. Chennai team.
Okay, yeah. Okay, right. Gupta sir, are you into some project now?
Yes, sir. I am with Pushpa madam.
Okay. Yeah. So I was trying to see who is there anyone who is yet to be yet to get into some project?
I think Sangaya has not responded.
Singaya sir is with me, sir.
So
Singaya sir, myself, and Mr. T.
And Hajong.
Yes, sir.
Okay, I think all are covered, right? Hello, sir. Am I audible?
Yes, sir.
Yeah, you're audible. I think everyone is.
Yeah, all are covered.
Yes.
So maybe someone here who is maybe for network issues not able to talk to us now, if is not assigned to any project, so can do so. You can also guide him or her so that they can also start the project work. And so what we will do, sir, sometime maybe after 1 month, we will have 1.5 hour review to help you to see as to what extent you have come on that particular project. So are you facing any difficulty? If there are any questions, general questions, because specific questions we will not be in a position to answer because you are doing project in your own area. But general questions, yes, we will be able to guide you. Okay. As to in terms of drafting the project and the other inputs, maybe other inputs that we can offer based on your input from that at that point of time. Okay. So if there are any corrective measures, we can suggest. So we will meet after 1 month, okay, for 1.5 hours, so that we can do a better job. And we will be again after 1 month. After that is after that session, we'll be directly meeting into our regular sessions that currently that we are going through. And then the last session of the second spell, we will have presentations. Okay, presentations from you for about 15 minutes. Each presentation will be of 15 minutes and followed by the report submission. So that is the plan of action as of now. So is it okay? So shall we close now?
Yes.
Sir, in case we need to discuss something in between.
Yeah.
Currently, who is there, sir?
So if you, because something related to project assignments, you can discuss with Professor Mohanty.
Okay, sir.
You have that, he's already into the group. Okay?
Yes, sir.
So we will tell him, right? And after 1 month, we will have a review. Okay. So where we will try to rope in Professor Mohanty and also faculty from finance background. Okay, sir.
Okay, sir.
Yeah. So fine. So as of now, how is the program going on?
Very okay, fine. Very good.
Very good, sir.
Okay. Okay. Thank you. Any further inputs that you would like to give so that we can incorporate that in the second spell? Of course, there will be more concepts on project management itself. And
session should be more interactive. Session should be more interactive, more question answers.
Okay.
Sometimes it is monologue.
Okay, fine. Okay. So the point well taken. So there will be more technical sessions on project management in the second spell and also on the alternate financing subject. And we will also have some issues on the analytics part. Okay. So 2 sessions will be on analytics, 2 sessions will be on finance, and 2 will be on project management. So that is the agenda as of now. So okay. So in general, the program is you are taking. In general, you are. I think you are. You are able to learn, right?
Yes.
It's quite good.
Okay.
Quite good.
So
very good.
Thanks for your inputs. We will try to make it more interactive. Okay. So we will ask the faculty to make it more interactive. Okay. So you can also please feel free. Okay. Feel free. We are here to help you. Okay. And you can always because I already told in the beginning of this particular program. You are senior officers, you have expertise in your own area. It is not a teaching session. This is interactive sessions that we are supposed to be doing. So please stop the faculty without any hesitation. Okay, if he is going fast, if you're not able to understand, absolutely there is no issue on that. And from our side also, we will tell them. We will tell them to maybe go a little slow. Okay. Yes, sir. Is it okay?
Yes, it is.
Yes, ma'am. Yes, ma'am is okay.
Yes, it's okay. Perfectly all right.
Okay, thank you. And yeah, we have at 12 o'clock. So you have quick, you have tea or coffee, whatever that you'd like to. We'll join meeting at 12:15. Professor Venugopal will continue. Thank you, sir.
Thank you.
Thank you. Yeah, and please post your topic and with whom you are pairing up in the WhatsApp group. Okay.
Just 1 minute, just you wanted some suggestions or inputs for next session.
Yeah.
See, now the current theme in railways is the monetization privatization. Of course, today's lecture, what is going on is very, very relevant. Securitization.
Okay.
But it is different.
Yeah,
Securitization.
it's different. It's different. Some related topics. So something on PPP or kind of a thing in the second, whatever is the upcoming after
Second spell.
second spell.
Yeah.
A bit more focus on PPP or this
Monetization.
of train services, related topic where these are the areas which are new. Not many officers are exposed. So any discussion of this will be extremely useful.
So one suggestion is on the partnerships, right?
Yeah, public-private partnerships.
Yeah.
Then privatization, like this privatization of train services. So what are the issues that are likely to come up? Then something related to finance. I mean, how we should put the conditions or implementation is what most officers will be dealing actually. As a policy and all, of course, is done in the board. But how these contracts are made and what are the critical issues in these contracts? What are the risks that are likely to crop up? So those things, any lectures on that will be useful.
Okay, risks involved during privatization process.
During the privatization process and implementing these contracts, what are the things that are likely to arise?
Okay, okay.
Yeah.
Fine, sir. I have taken note of it.
Thank you.
Yeah, thank you. Okay, please.
One more subject in that continuation was Mr. Srinivas has said. See,
Yeah.
the government is going for monetization, and a lot of, in the budget, a lot of announcements are made there. So, in case study in international level, that means in many of the countries this might have been done. So, what are the pros and cons of the monetization and the previous experiences? So, we can learn from that, and probably when we are going for it, we have to take this risk mitigation plans so that we should not fail them. I think probably that's some topic can be covered in next sessions.
Okay, if it is covered at an international level, so we will, you are asking us to cover that, right?
Yes, because it is India, it is a new concept now, I mean, particularly for the railway sets and all that. So we do not know whether such exercise has been carried out elsewhere.
Yeah.
If such experiences are there or some case studies are there, if they can be brought in and can be discussed, I think that will be a better understanding for us.
Okay, so on the modernization, right?
On the monetization.
Okay, monetization. Okay,
Yeah.
okay, monetization, right? Okay. Okay, and also on maybe modernization.
Yeah, modernization also, but right now the theme which is government is seeing is towards monetization. So that's why we suggested the
fine. Okay, right. Thank you. Okay, so we'll take a break here. Join at around 12:15 or 12:20. Okay.
Okay.
Yeah.
Thanks.
Okay, thank you.
So everyone, welcome back. Are you all there? Mr. Sanjay, Srinivas. Are you all there? Sanjay Kumar, Alok.
Yes, sir. Yes, sir.
Yes, sir. Yes, I'm there.
So can I start off, resume my session? So Sanjay, Pushparani, madam.
You can start.
Balaji.
Yes, please start.
Okay. So welcome back to the second session. Here, this session will be mainly focusing on the project funding. What are the different sources of project funding? The big projects, infra projects, and with a specific reference to railway projects. We will see how railway projects are being funded. We'll take the example of Konkan Railway, Delhi Metro, Hyderabad Metro Rail project. We will take these examples and see how these projects are being funded. So first of all, conceptually, how these big projects are being funded. What are the sources? Which are the different sources available? Which are the different institutions from which you can source? What are those instruments? We'll first see those items, and then we'll take the practical examples of how these railway projects are being funded. Okay, which are the different instruments used? We'll look into that. Okay. So first of all, long-term capital. I'm sharing the PPT. Please confirm if you can see it. First of all. Okay. Yeah. Please confirm if you can see. So any project, it requires funds, long-term capital to fund a project. In a project, you are acquiring fixed assets like land, building, machinery, equipment, furniture, fixture, computer, hardware. Like that, you are creating fixed assets which will help you to conduct your operations, right? So that requires long-term funding. The long-term can be 5 years, 10 years, 15 years. Infra projects will take very long time. 10 years, 15 years, 20 years, 25 years type of funding is required. So what are the different sources of capital available for such projects? You can see equity, debt, derivative markets are there. Equity and debt are the main sources. Equity is in the form of common equity, preference shares domestically, and debt market you have the bonds, corporate issue the debentures also, bonds and debentures, and for short-term sources you have the money market instruments and derivative transactions. Derivatives are of course used for risk management also. So the common instruments are the equity and debt, and for short-term the money market and the derivative instruments like forwards, futures, swaps, and options. These are the different sources. Internationally, if you look at international type of capital sources, you have ADRs and GDRs, which are very commonly used by Indian corporate, American depository receipts, and global depository receipts. These are the sources of international capital. IDR is an instrument, Indian depository receipt, which and foreign companies raising capital in India. In case of ADR and GDR, Indian companies are raising the capital abroad by issuing these instruments. IDR, foreign companies are issuing these in India and raising capital for their projects. So that's the difference between ADR, GDR, and IDR. ADR is issued in US, listed in US, and traded in US. GDRs are in other places also, globally. They are issued globally. ADRs are only in USA. You have other instruments like foreign currency convertible bonds. This is a debt instrument. Convertible bonds, convertible into equity. And foreign currency bonds, Yankee, Samurai, Dim Sum, Euro bonds, like that. Each one is issued in different countries. Yankee bonds are issued in USA. Samurai bonds are issued in Japan. Dim Sum bonds are issued in China, Hong Kong. Euro are in other places, Euro. Masala bonds, have you heard of this name? The finance people, have you heard of the name Masala bond?
Yes.
Yeah. Yeah. How it's different from other bonds? So bonds are debt instruments, which are long-term debt instruments, usually issued for a period of 10 years, 15 years, 20 years, like that.
These are rupee denominated bonds.
That's right.
basically to avoid the forex risk.
That's correct. That's right. Masala bond is a bond issued by Indian company in foreign markets, but denominated in Indian currency. So the Indian company does not face any exchange rate risk. It issues in rupees and pays in rupees, redeems in rupees. So does not face any exchange rate risk. Otherwise, normally in a foreign currency bond, what happens? I issue in foreign currency. I pay in foreign currency. I redeem in foreign currency. What all interest, dividends I have to pay in foreign currency. Redemption also in foreign currency. So I, as an issuing company, face exchange rate risk. But Masala bond is one such bond, even including Maharaja bond also. They are issued in Indian rupees, and we do not face any exchange rate risk. Green bonds and blue bonds, these are basically for environmental friendly projects. They are green bonds. Blue bonds are ocean creatures, living things, conservation type of protecting the ocean related resources. You are undertaking a project. That's blue bond. So these are the different bonds. Foreign currency convertible, Yankee, Samurai, Dim Sum, Euro, Masala, Maharaja, green and blue. There's a general source of long-term debt instruments. Otherwise, you have basic coupon bonds and zero coupon bonds. This is one fundamental difference. Coupon bearing bonds pay regular interest. Zero coupon bonds do not pay any regular interest, but they are issued at a discount to the face value. On maturity, you pay the face value. That's zero coupon bond. Other than this, you also have a floating rate bond where the interest rate on the bond is not fixed. It is linked to one reference rate like repo rate like that. As the RBI changes the repo rate, the interest on the bond also keeps changing. This is floating rate bond. Coupon bond, zero coupon bond, floating rate bond, inflation indexed bond, which is adjusted, whose principal or interest is adjusted towards inflation. That type of bonds are also there. Then you have other varieties, puttable bond, callable bonds. Bonds which carry put call options for an early exit. For example, a company issuing a callable bonds can redeem the bond before maturity, but after lock-in period. Say something like, I'm issuing a 10-year bond, but a call option after 3 years. The 3 years is lock-in period. So after 3 years, anytime I can pay the money and close the bond. This is call option. Put option is investor can surrender the bond and close it before maturity. So these called put call options which are available in a bond. But otherwise, that is in terms of your principal and interest and payment related. Coupon bearing, zero coupon, floating rate bond, then puttable bond, callable bonds. In foreign bonds, these are all FCCBs, Yankee, Samurai, Dim Sum, Euro, Masala, Maharaja, green, blue bonds like this. The variety of bonds which you can issue in the market to raise capital to fund your projects. Otherwise, the conventional source, these are all marketable securities. You are issuing bonds which are tradable in the market. But otherwise, the conventional way of raising funds for your project is a long-term loan. A loan you take for 10, 15 years, 20 years, and you repay in installments along with interest. They're called long-term loans. This is the conventional source. But you have, these are all the options available, different bonds which you can sell in the international market as the additional source of finance which is available to you, long-term finance. But who are providing the conventional loans? You're taking the loans from financial institutions, DFIs, development financial institutions, which are providing long-term loans. There are local development financial institutions called DFIs, and you also have foreign financial institutions. Let us look at them. In India, you have IDFC, IFCI, okay. Then you have the specialized institutions like Power Finance Corporation, Exim Bank, NHB. They're all specialized financial institutions which provide long-term loans. But internationally, infrastructure projects, railway project, for example, sea project, airport, They also source metro rail project. They all source funds from international institutions also. Who are they? They are multilateral development banks. For example, they are called MDBs in short, multilateral development bank. Example, you have a World Bank, International Bank for Reconstruction and Development, also known as World Bank, European Investment Bank, Islamic Development Bank, Asian Development Bank. See, these are some of the development banks, multilateral development banks, which provides long-term finance. So your big projects can source money usually from these World Bank, European Development Banks, Asian Infrastructure Investment Bank, AIIB, Asian Development Bank. These are the common institutions from which you raise the finance. You have others which are called international financial institutions, Bretton Woods institutions, which are, example, International Monetary Fund, IMF is one such example, International Finance Corporation, International Development Association. These are some international financial institutions from which you can raise money. You have something like European Commission, International Finance Facility for Immunization. There are other institutions which are also providing, like these International Investment Bank, Arab Bank for Economic Development. They're called multilateral financial institutions. These are international financial institutions. These are banks, multilateral development banks, from whom you raise the money. So they are basically long-term sources, usually 10 years and above, to take a borrowing. And projects which are funded generally, you can see here, urban projects like metro rails, bridges, flyovers, infra projects. They are funded generally by these type of institutions. They fund, if they are financially viable, they will fund. Example of this, you can see the funding pattern of, we'll take a project, something like your Delhi Metro Rail project. We'll take one example. How many of you have worked with this project, Delhi Metro, by any chance? Any one of you? Any of you have an opportunity to work in this project, Delhi Metro? Okay. Anyway, just look at this cost and the source of finance. Estimated cost in the first phase was 10,571 crores. And funded by the government, government share is this much. Subordinated debt towards cost of land, Japanese Bank for International Cooperation. So this institution has been very active in funding metro rail projects in India, especially this one, Japanese Bank for International Cooperation, JBIC. 64% of the funding is done by them. Rest from the government, and rest by proceeds from property development. 64% funding done by Japanese Bank in the first phase, Delhi Metro Rail project. In phase 2 also, you can see JBIC contributing 64%. They use the word subordinated debt. So subordinated debt is subordinated in terms of repayment. So that means there is one debt senior to this. Payment to these people will be made only after the senior people are first made. They have to be paid first, and then the subordinated debt instrument holders will come into picture. So this is subordinated debt, but generally carries a slightly higher interest than the senior debt. Konkan Railway project, you can see $34 lakh, this many shares allotted to Ministry of Railways. This is equity. This is funding is equity. 34 lakh 22,194 shares allotted to Ministry of Railways, Government of Maharashtra, Goa, Karnataka, Kerala in 1992. Look at 16th November in the same year, 93, they offered 32 lakh tax-free secured redeemable bonds. Secured means there is underlying asset which is there, some building or some machinery or equipment, land, something is there, that is secured. In the event of default, those assets are sold and these people are paid. So they are called secured. Redeemable means it is repayable after a certain period. Bonds. Again, equity. So it's a mix of equity and debt. Debt is mainly in the form of secured redeemable bonds. And they are issued to NRIs also and redeemable after 10 years. Konkan Railway project. And in 94, again, fresh equity funding is done. 1996, again, tax-free secured redeemable bonds are issued. 15 lakh, company of 15 lakh shares, worth bonds, sorry, at 10.5% interest they've issued. And the issue was oversubscribed. They've issued 15 lakh, it was oversubscribed. They've issued 20 lakh bonds, extra bonds are issued. Okay, so this is an example of how Delhi Metro and Konkan Railway have been funded through long-term sources. We have seen equity, bonds, and long-term loan from international institutions like JBIC, Japanese Bank for International Cooperation. So this is the pattern of funding in these metro rail projects.
Japanese bank is popularly called JICA, JICA.
JIC, it is called
JICA, JICA. So the JICA has funded this Delhi Metro and several projects.
Yes, yes, correct. So you call it JICA, it's JBIC. JICA, you call it JICA, right? Okay. So they have a very big share in this funding of these projects in India. Both Konkan and not in Konkan, but Delhi Metro, they are funded 64%. Konkan is mainly by issuing bonds, equity shares and bonds to government and outsiders, including NRIs. This is how Konkan Railway has been funded, mainly by issue of bonds. But you have other way of financing a project, big project, through a private public participation, PPP mode. I think you might have studied this elsewhere in one of the earlier topics. You must have discussed this already. Public-private. So wherein they come together to fund a project. Initially, the government gives the land and other initial capital support, but it is a private partner who raises the capital in the market. He takes the responsibility of raising the capital in the market. Public-private partnership. Most of the metros are PPPs only. For example, the Hyderabad metro project, which is happening, is a public-private partnership of L&T and the Telangana government. Right, so it's a PPP mode. In PPP also, you have different modes. BOT, BOO, BOOT, BOLT, DBFO, DBFLOT. The Hyderabad metro project is operating on this model. Public-private partnership, L&T Finance, L&T, rather, Larsen & Toubro and the Telangana government together under PPP. The model is DBFLOT, that is design, build, finance, lease, operate, transfer. This is the model, I think, on which Hyderabad Metro Rail project has been funded. L&T and Telangana government. So the advantage here is, see, if two people are coming together, now you are experienced people. So do you agree that PPP is a better model, or it's better government undertakes this? Yeah, it's open for discussion. Now, would you recommend a PPP or a purely private or a purely government project?
Of course, PPP has the potential for the money from the public at large. So that much of finance may not be available with the government. So it is increasingly being popular. The only thing is that the terms, like the previous experience of Hyderabad Metro, when it ran into quagmire because of the assets were not properly identified before the tender. That those many precautions will have to be taken so that there's a fair competition and fair parties do come up. But PPP is definitely the way forward.
Yes. So what's any specific advantage? Anyone else? Any other advantage you see in a PPP?
PPP, the one advantage is that the efficiency of the private sector comes into force apart from the finances which private players bring into the system.
Yes. Okay, that's good. That's correct. Actually, operational efficiency, speed with which you can do, because they have lesser in terms of system related delays. Because in a public, it does not mean public sector is inefficient. It does not mean they are inefficient. They are also efficient, but they have a set of procedures, rules, regulations, procedures. And for every decision making, they have to go through a hierarchy. There is a procedure which can delay the things. Okay. So, but whereas private sector people, they have that much, they enjoy that much more freedom. So the decision making is faster there. Also, it's easier for them to raise the finance based on their own balance sheet as compared to a government company, which takes much longer time. So private, the operational efficiency because of the speedy decision making process in private sector, that helps them. And so but government has got better resources in terms of providing you the infrastructure. Government has got certain advantage because they're clearing the legal hassles for procurement of certain assets like land, building. Government is in a better position to do it. Whereas private sector people, speedier decision making, and they can better operating efficiency because of that, and easier for them to write a quick financing also, financial closure also. They can make it much faster. So when you bring them together, for example, a Hyderabad Metro Rail project or a Delhi Metro Rail project, getting the clearances for the land and other things, environmental things, procurement of land, all these things, for private people, it's not that easy. It takes a lot of time and it will be very difficult for them. Government being the government, so it's much easier, relatively easier for them as compared to private people. So the required land for that starting that project and getting the clearances. So for government, it's relatively easier. So they do that and then hand over to the private people. So private people will get the financial closure much faster and their operations are much faster, so much relatively efficient. So when you are bringing these two people together, so you are combining the advantages. So you are achieving a synergy. Basically, a synergy is achieved through a PPP process. So initial capital, procuring the assets like land, getting the clearances. This is government is in a better position to do that. Faster financial closure, faster decision making, faster financial closure, operational efficiency. Private sector is better. So you are combining these two. So you are achieving a synergy. It is like synergy means 1 + 1 is not 2, 1 + 1 is 3, or 2 + 2 is not 4, 2 + 2 is 5. This is possible because you are combining the advantage of the two entities, two partners. PPP, precisely that advantage is there. So for example, L&T and Telangana government, central government, they are coming together and doing this project. So getting the clearances of procuring the land, getting the technical clearances, environmental clearances, everything is easy for the government. L&T could raise the required finance at much faster rate, which is not possible for the government. And L&T, with its experience in infrastructure projects and all that, they are able to lend a better efficiency and operating efficiency and speed in the implementation of the project. So you can see how well they are doing. L&T have done a really good job. This is the advantage of a PPP. Models are different: build, operate, transfer, build, own, operate. So here in this, the build finance, you are raising the finance also. Design, build, finance, like that. All these things are done by the private people. And then finally, you hand over to the government. You operate, that's called through a concessionaire agreement. For example, Hyderabad Metro Rail project has got a 25 years concessionaire agreement, during which period the L&T will recover its costs, profit, interest, everything. But if it is not able to recover, another 10 years extension is possible. So it will, during this period, it will recover all its costs, profits, interest, everything. And then finally hand over to the operations to the government. This is concessionaire agreement. This happens in this model. So meanwhile, the designing, building, financing, everything, operating, everything is done by L&T only. So that's the model. Government role is to procure the land hassle-free, in a hassle-free manner, hand over to L&T. That's the role of the government. And also give initial viability gap funding. Technically, they use the word viability gap funding. So VGF capital they provide, the land they provide, and hand over to L&T. L&T will do the financial closure, start implementing the project. So any infrastructure project for that matter will go through certain stages, which I will show you, which you have already learned elsewhere.
Like our solar plants also are there doing RESCO.
Yes, yes, that's also coming under this. Power projects, no, non-conventional project power projects.
Yeah, correct. Yes.
That also comes under this infra only. Now you see every project goes through this cycle. You can see the PPT which I'm showing now. Yeah, look here. This is a project life cycle. I think in earlier classes you have studied this. I think project life cycle goes through the initial identification, assessment process, due diligence, and closing the financials, then implementing, monitoring, operationalizing, and then debt servicing. This is how a project life cycle goes. You have seen in earlier classes, right? So similarly,
what is debt service?
Servicing is, you pay the loan installments and interest by implementing the project. For example, L&T, you are implementing the metro rail project. So from the ticket, selling ticket and advertisement, all that, you are collecting your revenue. From that revenue, what all loans you have taken? For example, JICA, you have taken a loan, Japanese bank. You have to service that debt. You have to pay that. Servicing the debt means paying the installment and interest regularly. Once you pay off, then the assets will be free. So this is servicing debt. These are the different sources. So there is a public source, there is a private source, and there is a social source of funding your projects. Okay. So these are the regular sources: conventional, internal revenue, taxation. Government does this. Or you go for external borrowings, foreign direct investment, external commercial borrowings, or international financial institutions giving you loan. External borrowing, that is, you are taking a loan from a overseas lender. This is one source. Or government grants is also one of the sources for you. Otherwise, regular revenue in the form of taxes, user charges, like that you can collect money. So in a public-private partnership, you are accessing the capital market also by issuing shares, bonds, debentures. You can see some more loan financing sources, community participation, public-private sector participation, and these models of BOOT, BOLD, BBFOT. And accessing capital market by issuing equity, debt, municipal bonds, infra bonds. Pooled finance means this is another source called loan syndication. Have you studied this in any of the earlier classes? Loan syndication, where the investment bankers pool the loans from different institutions. Now the problem is, let's say you are doing a railway project. You need something like 10,000 crore loans, long-term loans. Now, no single institution will give you that much loan. So what will happen is this amount loan will be shared by different institutions. But who will coordinate that? So there is a process called loan syndication. You have to assign this to an investment banker who in turn does this loan pooling called loan syndication from different institutions. So you are handing over the responsibility of pooling it to the investment banker. He is going to the market. He is negotiating with different institutions and pooling the loan from them. So that is loan syndication. It's called pool finance. These are the debt instruments. Okay. 1 minute. Just a minute. I'm opening another one. Show you. Just a minute. This is opening still. You're just opening a document. Just a minute. Give me a moment. Okay. Yeah. Slow in opening. Just a minute. Yeah. Yeah, please confirm if you can see this. So these are all the different instruments and vehicles for infrastructure financing. Can you see this particular page, which I am displaying now?
Yes.
Yeah, you can see this is a combination of fixed income means debt, mixed is hybrid, then pure equity instruments. So in fixed income, you have these securities called bonds and direct loans. So you have this type of infra bonds, green bonds, blue bonds, are the foreign bonds. The sukuk is nothing but the Islamic bonds, which complies with the Sharia law, that's sukuk bonds. Otherwise, this is for infrastructure projects, corporate bonds they issue, subordinated bonds. And in terms of loans, it is directly from different institutions, including international institutions. And the process you have syndicated loans are there, securitized loans are there, which we discussed in the morning. So the asset-backed securitization.
What is syndicated loans?
As I explained to you, in a syndicated loan, a very large amount of loan quantum is being pooled by an investment banker for the company. For example, you want to set up a infra project like railway or an airport or a seaport like that. You want something like 25,000 crores or 50,000 crore loans. So some you may be raising by bonds, some you have to take a direct loan, but no single institution will give you that much loan. Then you need to go to different institutions. So you do not have the time or necessary infrastructure to do that. approaching different institutions simultaneously. So this is a professional job which is normally done by an investment banker. So you hand over this mandate or assignment to an investment banker. He will pool the loans from different institutions, and that is called loan syndication. Syndicating or pooling the loan from different institutions.
Okay.
So all the different the terms and conditions are decided. Okay, this is the tenor of the loan, rate of interest, this is security, these are the documentation, security charge like hypothecation, mortgage, everything is decided. And then, you know, this loan is being marketed to different institutions. So the interested institutions will participate in the loan on those terms and conditions. So this is syndicated loans. You can see mixed is hybrid. Hybrid, you will have a mix of all the subordinated bonds, mezzanine bonds, junior subordinated debt, senior debt, mezzanine, convertible, preference shares. These are all hybrid instruments which have the features of a mix of equity and debt. Preference shares, convertible bonds. Then you have pure equity, listed, unlisted. Listed is where you are going for an IPO, FPO like that. Or unlisted is directly private placement. You are placing your shares directly with institutions, individuals, high net worth individuals, institutional investors directly. This is unlisted private placement. Or public issue to IPO, FPO like that. So these are the different sources through which you raise the long-term funds for financing your project, especially infrastructure type of projects. You can see that all these instruments. You have anything to ask about any of these instruments? You can ask me. You want to ask something about these instruments? Any understanding you want particularly about any particular instrument?
So that fixed income and debt, are they mean the same?
They mean the same, because debt instruments carry a specific repayment, you know, the repayment in terms of interest and capital. That's why they're called fixed income. They pay a fixed coupon interest, right? So that's, you buy a bond and hold it till maturity. You keep getting certain regular coupon interest amount, and on maturity the principal. So it is fixed income. In between it is tradable. So when you are trading, it may give you some premium appreciation or a depreciation. That is possible. But when you are holding that instrument for, sorry, sir. Sorry, you asked something. Okay, fixed income and debt are same in short. So debt instruments are generally called the fixed income securities or instruments because they carry a fixed rate like coupon rate, and on maturity the principal amount is repaid. They are called fixed income security. Mixed are those hybrid which have features of both equity and debt. Example, your preference shares are there, convertible bonds are there. So they carry the features of both equity and debt. Equity can be direct through public issues, IPOs, FPOs, rights issue like that, where general public are allowed to participate and subscribe to the capital. The other one is private placement. So in a fixed income, you have both again through public issue of bonds or private placement of bonds or direct loans from institutions. Either you go and apply and take the loan, or you get the loan syndicated if it is very large. Syndicated loans. These are the different types of instruments used. Now we'll know about something about FDI, foreign direct investment, and external commercial borrowing. We'll discuss that also. But here, anything you want to discuss, let me know.
Under the equity, there's this IITs and MLPs under corporate balance sheet. Our REITs, we know the real estate, but IITs and MLPs, what are those?
Closed-ended funds. These are a variety of pooled funds. So REITs are real estate investment trust.
Yes.
This is liability partnerships. So this is something like, you know, someone else is participating in that. These are participation These are pooled investments basically. These are all, both are a variety of pooled investments.
Okay.
REITs is also a pooled investment. IITs are basically infrastructure investment trusts.
Okay.
IITs are infrastructure investment trusts. Okay, so it's nothing. These all these are pooled investments. So you are collecting money, and then you are issuing units. You are investing in some assets which will generate some income, and this money you are being converted into units, which can be easily traded, transferred. So this money is invested in certain assets as per the predetermined objective. REITs, for example, you see, I am investing money into real estate projects, which will generate me regular income. So what I'm doing, I'm pooling money from investors, investing into income generating real estates. So whatever income I generate in the form of rental and all that, I will distribute in the form of regular dividend. And when the real estate property is appreciating, my mutual fund unit also will appreciate. So there is an appreciation in the unit price, plus I will have a regular income in the form of dividend, which is paid from the rental income that is generated from the properties. That is basically REITs. Similarly, InvITs are there, which is also called IITs here. So infrastructure projects like your railway, roadway projects or highways and all that, the toll collection will be there now. So the toll collection will be the underlying asset. I will issue units and I will invest into these projects, which will give me regular cash flows in the form of toll collection and all that, which I will use it for paying regular dividend to the investors. So this way, you know, I am able to raise bigger amounts. I'm making people to participate, raising bigger amounts so that I can undertake bigger projects and I can also spread the risk. So through these pooled investments. So REITs, InvITs, they're all pooled investments, which are usually put in real estate projects, infrastructure projects like that. Okay.
So which are safer, sir? That means bonds shares are better for raising investment or over loans. Loan is fixed outgo.
You are talking from the company point of view,
yeah,
or investor point. Company point of view. See, it's not easy to raise a capital in any one form, full money in one form. First of all, there is a regulatory requirement that you need to have certain minimum capital contribution as an equity. So suppose you are undertaking a project going to a public to raise money for remaining money, you need to have minimum 20% of promoters' equity is one such regulation. So for example, SEBI says the promoters who are going for a public issue must have a minimum 20% of equity contribution post public issue. 20% promoters' contribution must be there in equity. So, and the remaining portion you can raise from the public in the form of a mix of equity, debt, and all these things. Both have certain advantages, disadvantages. So this is actually a process called capital structuring. So if you are going to an investment banker, project consultant, they will help you to structure this capital in a mix of equity and debt, because they enjoy certain advantages and certain disadvantages. So when you combine them, there is a better benefit. How it is beneficial? Now, first of all, equity has got certain advantages because there is no pressure of any payment, regular payment on that. You will pay dividend only if you are earning profit. There is no compulsion on the part of the company to pay dividend. So there is no such pressure on equity. But if you are not able to pay them for longer periods, then investors will try to withdraw, sell off their shares, and the share price will crash. And I cannot raise further capital in the market. That problem is there with equity. If I have too much equity. If I resort to debt, the advantage is that the debt will provide me tax benefits. It is a better tax planning tool, because whatever interest I am paying on the debt, it is charged to the P&L account. So I save tax on that. So it is a tax efficient tool, debt. Secondly, Once I pay off the debt, there is no more burden on me. They are off my balance sheet. They are out of the picture. I pay their principal, I pay their interest. They are out of the picture. They are no longer in the picture. And they also do not have any voting rights. So they don't create any nuisance for me in my operations. That's the advantage in debt. One, it is better tax saving, helps me to save tax because interest is debited to P&L account. So I save tax. Second, once I pay them off, they are no longer nuisance for me because they are off my balance sheet. Third, they don't have any voting rights. So they do not create any day-to-day nuisance for me. This is the advantage of debt. The disadvantage in debt is if I'm not able to service that debt, means I'm not paying the interest on time, I'm not paying the principal on time, then they have the right to initiate a winding up proceedings against your company. They have that power. They can go to NCLT and they can initiate an insolvency proceedings or winding up proceedings against your company if you are not servicing the debt. But as long as you are able to service the debt properly, repay them on time, debt is a good tool. But you cannot have too much debt also. You cannot have too much equity also. Too much equity, they have voting rights and they can create nuisance for you. And they expect you to pay dividend also. They expect the share price to go up. Otherwise, they will sell off and causing the crash in the share price, which makes it difficult for you to raise capital in future. That's a problem area in equity. So one more problem in too much equity is that someone else can take over the management control. Suppose you have 20-25% equity share, fine, all right, and you are gone for public issue. And later on, someone else can buy the shares in the open market and they can take control of your company. So this threat of a hostile takeover is always there when you have too much equity. So you must have a mix of these two, a balanced, so that you combine the advantages of equity and debt and eliminate the disadvantages, right? That's why you should have a proper mix. Also, it helps you in optimizing the cost of funds also. If it is a mix of equity and debt, your cost also will get optimized because in cost of funds, weighted average cost of funds is calculated. You are using this weighted average cost of funds to find out your net present value, internal rate of return, and all these things. When you are using these tools, financial appraisal tools like payback period, NPV, IRR. So you are using a discount rate to discount your future profits to find out the financial viability of the company. So your cost must be optimized. If there is too much cost, then project financial viability will be a problem. So if you have a mix of equity and debt, it will optimize your cost and make it financially viable too. That's why you should go for debt also along with equity. And in debt, of course, there are marketable, you have a variety of instruments, bonds, debentures, asset-backed securities. Then you have direct loans from different institutions. And if the amount is too large, you can go for a loan syndication. You can source in from domestic institutions in international markets by issuing Masala Bonds, Yankee bonds, Samurai bonds in different countries. You can source the capital through international sources also. So the variety of options are available with you. Now, any questions here? I take a pause here. Questions from your side? Anything you want to ask? Anything you want to ask, please ask me. Take a short pause, 1 minute pause for your questions.
How is the bond market in India in general? Bond market, is it a shallow?
No, it's not. It's not very big. Oh. See, internationally, the debt market size is almost 300 billion.
Okay.
Something like wait a minute, it is
even
128. Okay, 128, 300 billion is the debt market size. Equity market 75 trillion. It's trillion, it's not billion, it's trillions, it's trillions, it's trillions. It is,
How much is
two,
300
it is
trillion?
290 trillion is the debt market size globally. Out of which 130 is the bond market. Bond market itself is something like 130. Total debt market size is almost 300, whereas equity market size is something like 95, just around 100. So debt market size is 3 times of the equity market size. The equity market size you assess by market capitalization. So it is something close to 100 trillion. Debt market size is 300 trillion, 3 times of the equity market size. So debt market out of 300 trillion, something like 130 is bond market itself. So you have all other debt instruments, including asset securitization, securitized assets, direct loan, all put together, it is 300. Now, Indian debt market is just around 2 trillion only. It's pretty small as compared to the global debt market, right? So Indian bond market also, Indian overall debt market is much smaller as compared to the global. You can see it varies 300 trillion and varies 2 trillion. It's pretty small.
Sir, can you please tell about the during the 91 liberalization, what happened with capital structure? This foreign people, this liberalization means they invested in the they have some FDI.
Yes. See, yeah, that's right. That's right. In the economic reforms, which were implemented, one of the important regulatory change is that Indian companies are allowed to raise capital from overseas markets, foreign direct investment, external commercial borrowing, like that. These are the modes. So in a foreign direct investment, the foreign companies can invest into the capital of the company. For example, banks can have 74% FDI. Insurance companies can have 49% FDI. So similarly, infrastructure projects can have FDI, foreign direct investment, in the form of a capital equity participation. Or else you can also go for external commercial borrowing mode, where you take loans from foreign institutions, like your JICA, which you mentioned. So that comes under external commercial borrowing. You are borrowing directly from a foreign institution. So Indian companies, including public sector, they are allowed to borrow from these external people under these economic reforms. You are allowed to issue instruments. You are allowed to take direct participation from them, FDI, FPI, FDI participation, external commercial borrowing in the form of a loan or in the form of a supply of machinery, equipment, technology support. Any which way, you are allowed to access the foreign markets, right? So this is a very key, a very important economic reform, FDI, ECB and all that. Well, let us look at that now. Let's talk about FDI first. You have raised that point, so now I'll move to that FDI, FPI and those things. I'll move now. Okay, you can see this PPT. FDI, please confirm if you can see.
Yes, please.
Yeah. So the FDI is when a company takes controlling ownership in a business entity in another country. So I am Indian company. In my company, some foreign company is taking equity stake and controlling it. It has got a controlling stake. Foreign direct investment. So direct investment into your equity. Mostly it is controlling equity. So they participate in the management also. Directly involved in the day-to-day operations. So they have operational control. They bring in money with knowledge, skill, and technology. The advantage in FDI, it is not just capital, especially capital intensive project like infra projects, okay, where you require a lot of capital. So Indian companies may not have that much capital to undertake big projects. So you need someone from outside who can bring in that much capital. So you are seeking the help of foreign investors who can participate into your equity. So when they are bringing in capital, it's not only money which they are bringing in, the latest technology, the skill sets, they are bringing in. So this way, you are growing qualitatively also. You are updated technologies coming to you. and people with latest skills. So the skill development also is happening. So you are upgrading yourself into the next level. This is possible through an FDI. It is not just money. It's technically also you are growing through an FDI investment. So FDI takes place when an investor establishes foreign business operations, acquire foreign business assets, establishing ownership rights basically. So this brings in money, required capital, so that you can undertake big projects and with latest technology and skill sets. That's the advantage of FDI. FDI is two varieties, automatic route and approval route. Automatic route, you don't require government permission. You just have to inform. That's all. You take the capital and you inform. So they are, you see, these are all under automatic route. Infrastructure company in the securities market, 49%. Insurance, 49%. Medical devices, 100% automatic. Pension funds, 49%. Petroleum refining, 49%. Power, 49%. This is automatic route. It does not require government approval.
This they can buy the shares directly.
Yes, that you can invite participation by the foreigners to this extent without government permission. You can directly take money from the foreigners, foreign companies, institutions, and issue them shares up to this much percentage. But under government approval route, this is how it is. Under 100% government route, retail trading, for example, it requires government permission. There is no automatic route. Multi-brand retailing, 51% is under government. If you want 51% stake, government approval is required. Print media also coming under government approval route.
One question. Yeah. This Amazon is doing the business here, online business. Under which category comes here?
It's not multi-brand. It's a FDI only, foreign direct investment only. And it is actually setting up its own operations. This is not bringing in capital into an Indian company. Multinational people are allowed to invest directly. They can start their own subsidiary and bring in capital and start operations. This is another way of doing it. They themselves pump in 100% capital of their own or majority portion.
So that means they are starting new business directly.
Yes, you are starting it. Yeah, that is permitted. Okay. That's also permitted under FDI. See, there is another term used, FPI, foreign portfolio investment, foreign direct investment, portfolio investment. So this is basically, this is mainly in the form of an equity. This can be in the form of different instruments, portfolio, equity, debt, money market, bonds, money market instruments, equity instruments. A combination of different instruments is FPI, foreign portfolio investment. But these people are generally into short term, where FDI is long term. FDI is long term. They have a controlling stake and they have a lock-in period and they are participating in the management and they are there for long term FDI. FPI people, generally, they are interested in making quick profits. They mainly participate in the secondary market of shares, bonds, which are already issued, listed and traded. So they invest in those to make quick profits. So their outlook is short term. FDI, on the other hand, is long term. They bring in capital, they bring in technology, machinery, equipment, and they participate in the management. And their outlook is long term in nature. This is short term in nature. Both are required, but FDI investment is always better for the economy because that is there for longer periods. Whereas these people want to make quick money and get out. FPI. Portfolio investment is mainly to secondary, short term. They trade, make profit and get lost. That's how they do it. Say, for example, through a secondary market route, the Indian rules are very straightforward. In the secondary market investments, you cannot have more than 24% investment in a particular company. This is a secondary market rule in Indian markets. So a foreign player wants to buy into the shares of the company in the secondary market, he can buy up to 24%. NRIs can buy up to 10%. So this is the rule. So you will not have a management control. You have a stake, you do not have a management control. Your objective is to make quick profit. Your share price is going up, you sell and go out. This is generally a portfolio investment into the secondary market. FDI is direct investment into equity, and for long periods, you are there in the management, and your commitment to that project is for long periods. So which is good for the economy, for long-term growth prospects. FPI, on the other hand, will provide much more what we call a liquidity to the required liquidity to the market, because these people will come and keep investing regularly, trading also. So it will create a good trading volume also, liquidity also to the market. FPI, that is the advantage. But they are not long-term in nature. They can start withdrawing suddenly. See, for example, whenever Federal Reserve is changing the interest rates, these people will quickly react. Federal Reserve is increasing the interest rate, means these people will start withdrawing from Indian markets. So the money will suddenly start going out also. Whereas in FDI, it is not like that. They are committed for longer periods. There is a lock-in period. They are in the management. So their outlook towards that project is much longer periods. So it is good for the economy in general. So Indian Railways, coming to Indian railway projects, there are 17 key areas where FDI is permitted in Indian Railways. Since you're all from railways, you can see this here. 100% FDI allowed in certain railway activities. For example, installation and maintenance of bio toilets in passenger coaches. 100% FDI is permitted. Technological solutions for manned, unmanned level crossing construction. See, you can see these are all, not a complete projects, but a bits and pieces projects. One of the activities you are undertaking, not a complete railway project, but you can see a bit and pieces projects in railway infrastructure. Installation, maintenance of bio toilets. Technology solutions for manned, unmanned level crossings. Technological solutions to improve safety and reduce accidents. High-speed train projects. Mechanized laundry in railways. Producing non-conventional energy sources. Rolling stock procurement. Concessions of standalone passenger corridors. Testing facilities and world-class laboratories for experimenting new technology. Setting up railway technical training institutes. You can see this, they are all divided into different areas, different functions, different areas. Railway electrification for running electric trains. So in these areas, 100% FDI is permitted. But you cannot take a complete project. You can participate in each of these activities with 100% participation. So after the 1991 reforms only, all this is possible. You are allowed to raise foreign investment, Indian companies. ADRs and GDRs, which I've already mentioned, these are equity instruments. I'll show you some companies which have issued this. Look at these companies. All these have already issued the ADRs and GDRs. Bajaj Auto have issued GDR. Dr. Reddy's have issued both ADR and GDR. HDFC Bank has issued both ADR, GDR. Hindalco has issued GDR. Like that, you can see all these top companies, including L&T, has issued GDR. Tata Motors has issued. State Bank of India issued. They all have raised the capital from overseas markets. All big names you can see: Ranbaxy, Tata, State Bank, BSNL, L&T, ITC, Infosys, ICICI, HDFC. Big names: Bajaj, Dr. Reddy's. Some of the instruments issued and how they are faring in international market. You can see here, these are all the banks which have ICICI Bank, SDFC, Tata Motors. This is the ADRs which they have issued. And they are all doing well in the international markets. These are the current prices as on 18/5/2020. This is GDR prices, Axis Bank, KE, L&T, Mahindra. These are the traded prices in international markets. They have given, our Indian companies have given good return to the investors there. Our ADRs and GDRs have performed well. So this, for example, look here, these are the GDR prices in 2015. We will take one example. State Bank of India GDR price was 40.58. Issue price was 14.15. They've issued at this price, US dollars. And as on this date, it was trading at 40.58. Reliance Industries, it issued at 11.75 and it was trading at 28.1. You can see this is 2015 data. Let's look at the latest data. We'll take one example, SBI. SBI is now trading at 21.40. I think this is after the stock split, what they have done is 21.4. Reliance Industries, which was trading at 28.10, is now currently trading at 38.65. Mahindra, which was trading at 19.12 in 2015, is currently trading at 5.08. There's a fallen, price has fallen, Mahindra and Mahindra. Larsen and Toubro is 26.15. 10.86. This also is fallen. Actually, this is showing a fall in the price. I think this is Corona period. This date, wrong date to take. 18/5/2020 is Corona period, if I'm right. So the prices have fallen at that time. But still, if you compare with the issue price, all of them have given good profits. There's another category called Indian depository receipt, which are issued by foreign companies in Indian markets. Only one institution has done that, which is Standard Chartered Bank. And they've issued at 104, and that's in losses. Actually, it's trading just around 50 rupees. So Indian investors have suffered loss in this instrument. I will talk about ECB, external commercial borrowing. This is permitted after the economic reforms. For all your projects, you can go for external commercial borrowing under automatic route and under government approval route. So which all methods you can go for an ECB? All these instruments, loans, direct loans, suppliers credit. You buy the machinery, equipment, and those things on credit from a foreign supplier. It's part of ECB. Buyer's credit, foreign currency exchangeable bonds, financial lease, foreign currency convertible bonds. So mainly these are the main sources, these two, loans and FCCBs. These are the main sources of ECB. Greater priority for ECBs are mainly given for infra projects like power, oil, telecom, railways, roads, bridges, ports. Priority is given. Government clears these proposals much faster because they are under priority. Why Indian companies should go for foreign markets? Because domestic markets, you have a limitation in terms of how much your people can invest. Also depends.
Less interest, I think.
Yeah, one thing, you should also have money. People's earnings and people's net worth, people's interest in investing, everything matters. So when, especially if you are looking for huge investments, How many people are going to invest? There will always be a shortfall. So then you should have an alternative. That is, the foreign markets offer you that alternative. So scarcity of funds in domestic market, you need to look for an alternative market. So foreign ECBs provide a perfect alternative for you. Second most important reason why Indian corporate go abroad is the second one. First one is not the main reason, but it's the second one which is more important reason. The cost of funds is much cheaper as compared to the domestic market.
That's what I'm saying.
Yes, lower interest rates. That's correct. And freedom from exchange risk, non-encumbrance on assets. These are, I don't say exactly non-encumbrance is a big thing. It is secured, unsecured. Non-encumbrance is unsecured type. But still you need to pay. If you don't pay, you lose your reputation. So non-encumbrance by itself is not an advantage. You still have to pay. Freedom from exchange risk depends on which instrument you are issuing. For example, Masala bond you are issuing, you are enjoying freedom from exchange risk. Maharaja bonds you are enjoying, but not all. So there is automatic route, approval route, which we have discussed earlier. Automatic route, you just have to file, inform the government. And there are investment bankers who arrange you this. Reputed investment bankers arrange you this ECB from abroad under automatic route. So there is for example, State Bank of India does it. They arrange for the corporate to raise the ECB from foreign markets. All these people have raised ECB, that is loans from foreign institutions, Idea, Aircel, Vodafone, in telecom sector. Your Rural Electrification Corporation has raised money from abroad. Power Finance Corporation has raised. JPS, this is private sector, JP Associates, L&T, they also have raised money through ECB in the international markets. Major investment bankers who are arranging this is led by State Bank of India and other banks like PNB, Standard Chartered, Citibank. They are helping these Indian companies to raise money abroad, either in the form of instruments or through a loan. Another category is FCCB, convertible bond. So this is convertible into equity after some time. So the attraction is that you enjoy the benefit of equity appreciation. What is the advantage for Indian company to issue this instrument? Normally they carry lower coupon rate. So I can issue them at lower cost because I'm giving a carrot called equity conversion. This bond is convertible into so many shares, so and so price. So bond, when you compare to bonds, equity always gives a better returns, dividend as capital appreciation. So I'm offering this bond as a convertible bond. So it is convertible into equity after certain stage at a predetermined price. So investors will be more interested in the equity component. Till equity shares are issued, I get a fixed income. After that, I will have a shares which will give me good capital appreciation. So I get tempted by this. But for issuing company, there's a big advantage because since it is a convertible equity, I'm giving you benefit. So I will issue this at a lower bond coupon rate. So if normal bonds, other bonds are being issued at 8%, I will issue this bond at 7% or 6% like that. Because there is a convertibility option. Investor is more interested in the convertible portion. So he does not mind, he won't mind getting a lower interest rate till it is converted. So that's the advantage in FCCB. Issuing company enjoys that advantage. This is converted into certain ordinary shares at a preferred price, predetermined price, which is better than the current market price usually. So they will have a straightaway capital appreciation. That is the benefit that they will have. But naturally carries a lower coupon rate. And they're also listed and traded abroad. So they provide better liquidity also. So this is about FCCB. FDI FCCB, for FPI, okay, and the different instruments which are being used for raising long-term sources. Questions from your side, please. Questions from your side, please. I know you're all hungry, ready for lunch, but still.
Sometime when Government of India also do the external borrowings.
Government of India borrowing from international markets. Yeah, I may take a loan. I can take a loan.
Hey, are they doing it? Just I want to understand.
Normally, government issue bonds in domestic market itself to raise capital. Government issue bonds in the domestic market itself. They normally don't go, but the government agencies, government public sector undertakings, they take. Government may take a loan from these institutions like World Bank,
IMF and all that.
Yeah, IMF and like that. From them they take, but they don't take so often. Whenever it's a really needy situation, they can borrow from those multilateral World Bank type of institutions and they repay them. Yes, they can take, they do take as and when required. But more commonly, popularly, these public sector undertakings, private sector, corporate, they resort to these external borrowings rather than the government itself. That's the reason why all these, PPP and all these are becoming popular for this reason only. If government has to undertake all these projects, where from government will raise money? They need to borrow. So I don't prefer to borrow and I pay in foreign currency. Instead, I will make a public-private partnership and I will ask the private people to do the financial closure. I will not take the responsibility, because if I have to take responsibility, then I may have to borrow. For me to borrow, I may have to go to different institutions, including foreign institutions. I may have to. I want to avoid all those borrowings. So preferred route is go for a PPP, public-private partnership.
Okay.
Any other questions, sir? If you look at government budget, there also it will be shown how much money is paid towards interest on the borrowings. Every budget, if you look at in the budget, they will announce how a rupee is generated, how a rupee is spent. In that, interest paid on borrowings will also be there. So that is the portion which they have borrowed and paying interest on the external debt. So government wants to minimize that. So they are going more and more towards the public-private partnerships. So they leave the financial closure responsibility on the private people. They will not take the responsibility. Because more responsibility I take, more will be my problem, my cost, my money, my servicing problem will be there. I need to keep on paying. Okay. Instead, I give to the private people, give them concessionary period. They are more operationally efficient and they can raise the capital faster at a cheaper rate, and they are able to service better than me. For me, it will be a bigger burden. So I prefer, our government do not prefer now to borrow. They'll do only when it is absolutely necessary.
Okay.
Any other questions, sir? Any other question?
Okay. This financial, why this term financial closure is there? Because we are
financial closure. Financial closure means raising the finance, the required finance. See, in a project, I need to raise, say, 100 crores. I need to raise 100 crores, out of which 20 crores I'm bringing my own money. Remaining 80 crores I have to raise through different sources, by equity, by debt, and all these things. Financial closure means you are closing the deal. You have finalized the raising of resources through different instruments, through different sources. You're finalizing the deal is the financial closure. Its closure means not repayment.
Confusion.
Yeah, it is means closing the deals for raising the finance. Okay, sir. So thank you very much for patient listening. I know you're all hungry, must be ready for lunch. So any questions, you can also just message me on my number. Any questions you have on this financing part?
The number is there.
My number it's there, but you can note down also 98485.
One minute, but I need actually 98485
38882.
Okay. 98485 38882.
Yeah, that's right. So any queries you have?
This portion of presentation can be shared.
Yes, yes. I've already put it on. Put it with Mr. Nageshwar Rao. He will share with you all.
Okay, thank you.
Right. Yeah. Thank you very much. Bye bye. Take care.
Thank you.
Thank you. Thank you.